First and foremost, I wish to thank God who has made it possible for us to have this interaction. Further, I wish to thank the Institute. They have really been supporting us for organizing this workshop. Also, I wish to thank you as students or participants for finding time to join. I know you are busy people. I am your presenter, Boniface Musonda. I am a full-time lecturer at Zambia University College of Technology, which is based in Dora, Copperbelt. Then I'm also a consultant for Zika. I've been with Zika for some time. Then, of course, I do the online classes. Those are my contact details. Later on, we can interact. My presentation will cover 7 areas. I'll start with introduction, and I'll end with the conclusion. Introduction. The examination answering techniques will help you in terms of preparing for future examination. Like what Mr. Katumbu indicated, it's not only financial reporting, even for other exams. You can have knowledge, but you fail the exam because you are going to fail to manage 3 hours. So it's not about having knowledge, but how are you going to manage knowledge within 3 hours? I can assure you, the knowledge you have, if you can give you 1 day, you can get everything. But the challenge you are going to have is to manage the knowledge within 3 hours. There's one misconception that the pass rate is regulated by Zika. Like what Mr. Katumbu has indicated, if pass rate is regulated by Zika, then why have they organized this meeting? So I urge you to come up with the open mind, and you know that Zika is not the one who is in charge in terms of regulating the pass rate. It's you students in terms of the way you are going to prepare. The focus of Zika is to ensure that they are going to produce a graduate who is competent and ethical. So as long as you are going to demonstrate that you are competent and you are not ethical, you are going to graduate. So take note of that. Have positive mind. Let's forget about the past. I know maybe some of you have attended, you failed the September exam. You have got another opportunity. Just come with the open mind. I can assure you what we are going to interact. The question I've prepared a number of questions. It can make you get 50. So let your past make you better, not bitter, so that you are going to pass the exam we are going to write in December. Like what Mr. Katumbu indicated, you can see on the screen. Most of you have done ratios. If you can conduct ratio analysis, the performance was adverse. If you check CA2.1, 89 was highest, this time it was 69. The only improvement is in terms of the lowest mark. In June, it was 1%, this time it's 8%. Then in terms of the lowest mark also for DA8, it's the same. So you can agree with me that our Caring Institute, that's why they have organized this workshop. And the Institute and myself will be very happy if you can see that there will be improvement, because we also conducted the same training or the meeting, I think should be in August, but we have seen that the performance has deteriorated. So looking forward that we can improve this performance. I'll be very happy to see the December exam where there will be improvement. Based on the September exam, I got a letter from the Institute, and these are the areas which they highlighted, which I will try to go through. We'll try to propound in terms of accruals concept, also in terms of computation of goodwill, because whether you like it or not, there will be goodwill in the exam you'll be writing. Then in terms of consolidation, you are going to see the mistake which those who attempted in September made. Then also in terms of preparation of financial statement, because we are likely to come across the preparation of financial statement. Also, depreciation is one area which we are still struggling, despite we came across this principle in financial accounting. So we'll try to demystify IS16. Then also in terms of cash flow, if you check for September exam, both D8 and CA2.1, cash flow is examined. Then IFRS 3, which is a business combination, we'll go through how to compute goodwill. There were a number of issues which came through the chief examiner's reports. Also, IFRS 9 financial instrument, highly examined. They will try to help you in terms of time management and just a general preparation. Will give you the tips. It's important to know the format. So for D8, section A, there are two compulsory questions. I remember one of my students said, no, I didn't answer question 2. I only answered question 1, and then I picked 3 questions from section B. That's why we are going through this, one to help you. So be prepared. Maybe you have been revising using CA2.1, but you are writing D8, then you get confused. So take note, section A, there will be 2 questions. Question 1, unless otherwise, it's like to be on consolidation. Then question 2, it may be on published. I'm saying mostly. I can say virtually certain. Then the rest, any area of the syllabus. Then for CA2.1, question 1 is the one which is compulsory, which is 40 marks. Then section B, you attempt 3. So this is very important. Before you go to write the exam, you have to know the format. You are advised to attempt the required number of questions. I've seen a student who spent maybe 2 hours on question 1, you get 30. But only attempt 1 question in section B, where you get maybe even 12. So basically, what are we encouraging you? Attempt the required question. We haven't said all the questions, because you are going to attempt from 1 to 5, the required questions. This is very, very important, because like CA2.1, if you can get 25%, then the rest you simply get 10, 12, 11. Then you have passed the exam. So we need to manage the time. In terms of highly examined areas or items, group financial statement or consolidation, whether you like it or not, most for CA2.1, it will be the first question. Even D8, it's like to be the first question. So what I would encourage you, just pick even for September exam, what they wrote, just answer both D8 and CA2.1. I can assure you, you are likely to pass. Then also you are likely to be asked to prepare a financial statement for a single entity, which you may be referring to as published or company. If you go back to financial accounting, we discussed the forms of business. We discussed a sole trader, partnership, company. Financial reporting, sole trader, and partnership is not examined. So the way what to be examined is published or company. This is very, very important. You are going to see when you go through the examiner's comment for December, they indicated as students, they are still having challenges with the format for a company. Cash flow, it's highly examined. And I was shocked when I was going through the examiner's comment to find that someone got 0. So cash flow is very friendly. If you have to understand cash flow, you must know the difference between accruals concept and cash basis. When you are preparing statement of profit or loss, we use accruals concept. We recognize income when we earned, not when we what we received. Expenses, what we incurred, not only what we paid. But when you are preparing statement is simply a report of what? Cash flows, not profit. So when say cash flows are simply inflows and outflows of cash. The way it can be examined, now take note, it's not only about computation. They can ask you the advantage of cash flow. We are going to say it's very easy to prepare, audit, and understand. Why? Because it's based on cash basis. In terms of limitation, it's against accruals concept. Then also it depends on other financial statement. Of course, it can also be subject to manipulation. According to IS 7, when you are preparing cash flow, you must know there are 3 headings which you must know when you are preparing cash flow. You are going to, when you go through the examiner's comment, it was indicated some students, they failed to present even the statement of cash flow. So take note of that. So what are we going to discuss? When you are preparing cash flow, we prepare under 3 headings. The first heading is what? Cash flow from operating activities. Follow this order. Operating activities show the cash inflow and outflow to do with the day-to-day running of the business. Now, under operating activities, that's why you can use a direct method, or is where you can use indirect method. So when say direct method, basically what are we referring to? We are referring only show the gross inflows and outflows of cash. The example, you are going to say cash received from customers, other cash received, payment to the suppliers, payment to employees, and on behalf of employees. Then interest paid, then tax paid. That's a direct method, which is very easy to understand, mostly for non-finance manager, because it's in line with the objective of cash flow. Because the objective of cash flow, we want to know the company's ability of generating cash flow and how they are using cash flow. IS7 favors indirect method. So if the question will be silent, they just say prepare cash flow. Like if you check the both exam for DA8 and CA2.1 for September, it was indirect. Now, what's the mean when say indirect method? Instead, you start with cash flow. You are going to start with the profit. Now, why can't you pick profit as cash? There are a number of reasons. One, when you computed profit, we used accruals concept. You accounted even for income you have not yet received, expenses you have not yet paid. Apart from the issue of accruals concept, also you accounted for non-cash flow items. You accounted for non-cash flow items. What are the examples of non-cash flow items? Depreciation, impairment, amortization. There's no cash involved. Then apart from that, you are going to reverse non-operating items. You find maybe there's an item which was reported under operating, but it's a non-cash flow item. It's to do with investing and financing. After operating, the next section is investing. Please follow this order, not the way you feel or the way the ancestral speech is going to help you. Under investing, show cash flows and inflows to do with acquisition and disposal of non-current asset. Of course, at financial reporting, the acquisition and disposal will be in the form of PPE, intangible asset. But you are going to see, for those, I know there may be those who will be writing the CA3.1 Advanced Financial Reporting, there will be issue of acquisition and disposal of a subsidiary and also associate. After investing, then you go to financing activities. Here is how are you financing business? Here's where we're going to find issue of shares, repayment of a loan. So based on what we have discussed, when you go through even what came last sitting for D8 and CA2.1, you can agree with me that there's no need for you to get 0. At least you have to get 10 marks. Time will come for you to ask questions. So if there's any 1 or 2 issue, just take note of that. One area which is highly examinable is a conceptual framework. You are going to see through the examiner's comment, some student failed to comment on the conceptual framework. I won't blame you. It's a background or misconception. Financial reporting is not about computation. It's not about number crunching. No. Theory, you have to balance theory. And that's the area where we are lacking as students. So conceptual framework, you are likely to come across in the exam which you are going to write. That's the leakage I'm giving you. 1, you must know the definition. So what's a definition? Is a generally accepted theoretical frame of reference in financial reporting. Apart from that, ensure that you study advantages. 1, it promotes consistency or harmonization. Then ensure to know also the disadvantages. 1 disadvantage, we have got a variety of users with different needs. Also, it has not demonstrated to what extent it has lessened the task of preparing financial statement. The other area we may be tested is about the purpose. Now, most students confuse between purpose and advantage. We are going to see, it came within last sitting. Purpose, we are trying to appreciate why do we have it. So when you are answering only a purpose, you have to indicate to assist accountant as they are preparing financial statement, to assist investors as they are making investment decision. Also, you can say to assist auditors as they are explaining audit opinion. Now, the common mistake I've come across, students would simply say to assist the accountant. How? Is it as you are stealing money? So it means the question is hanging. You have to complete to assist the accountant as they are preparing financial statement. Apart from that, what are you going to be tested? You must know the chapters or section. There are 8 chapters or section. Ensure that you demystify all those. So if the conceptual will come, conceptual framework will come. These are the areas. Now, you may ask, why IASB? This is a document which IASB uses. Then why 2018 we are in 2025? Before you can ask me a question, that's when it was revised. So take note, we always encourage you to be using updated books or notes because you may studying the outdated conceptual frameworks. So to summarize, ensure to know the definition, advantage, disadvantage, purpose, of course, chapters. There are 8 chapters we'll go through. Another area is ratio analysis. So when you say ratio analysis, basically, you have prepared financial statement. Now I want to get more information to get a deeper understanding. What are some of the other areas? IS-32, financial instruments. Financial instrument is highly examined. You are going to meet vis-a-vis the exam you are going to write in December. So under IS-32, there are 3 areas you must revise. 1, there's what we call compound or hybrid instrument. This is where there are 2 components. There is equity and there is liability. Before, let's meet what is IS-32 is presentation of financial instrument, highly examined. So according to IS-32, present according to substance or nature, meaning what? If it's a liability, present under liability. If it's equity, present under equity. So that's why now we are trying to answer here. What happens where you have got a compound instrument where there is equity and also there is liability? Where are you supposed to present? You find the total amount is 500. So you say, are you going to present under equity the entire 500 or what? So the message separate split. Out of 500, liability, present under liability. Equity, you present under liability. Now, what's the process of splitting? First, to determine the present value of liability. Then the residue, because equity is raised, what will remain. And after you have splitted, equity will be constant. Then liability will start amortizing. Amortizing will start accounting for interest and any payment. If they want to test you on a compound instrument, they are going to test you on preference shares. Remember, people go through DA8 and CA2.1 September. If you can go and understand just the 2 papers, I'm sure you give a testimony that you're going to pass and also make use of the examiner's comment. Preference shares, we have got 2 types of preference shares. There's what we call redeemable. When you say redeemable, you have got an obligation to come and buy back. Like most of you are Christian, you know when you say my Redeemer lives. Jesus came and died for you, had no option. So if you check CA2.1, what came is redeemable. So redeemable preference shares, you present under liability. Then irredeemable, you present under equity. So you're going to see the examiner's comment. They brought redeemable preference shares and most students presented under equity. The other thing you like to be tested is on dividends. Before I can go to dividend, the requirement is if you are paying interest or dividend on a liability, that interest or dividend you report in profit or loss. But if you are paying on equity, you take to equity. So the good example, which is likely to come across in the exam, is ordinary dividends. Take note, ordinary dividend we are paying on equity. So ordinary dividend, it's an appropriation. It's not an expense. So it should never be reported in profit or loss. I remember even for August exam, I preached, but when I went through the examiner's comment, both D8 and CA2.1, they indicate that students have continued presenting ordinary dividends in profit or loss. So if you are here, please, ordinary dividend should never be presented in profit or loss. It's an appropriation. You debit retained earning through the statement of changes in equity or direct. IS-32, you are likely to come across device convertible preference shares, and the dividends. Other area is IFRS 9, financial instruments. So financial instrument, there are 3 areas which be examined in financial reporting. 1, in terms of recognition. So recognized upon being a party to the contract. So they will tell you a company got a loan on 1st October. So the meaning here, means what? you start accounting for a loan in October. Apart from that is derecognition. When said derecognition means when should you stop showing an item in a financial statement. So in this case, it means when it's no longer part of the contract, like when you have paid or when you have received. Apart from that is classification. We are going to see, we'll go through the classification. Apart from classification, also it's an issue of measurement. So take note, there are two areas which are really examined in advanced: age accounting and impairment. So age accounting and impairment may not be examined in financial reporting. If it will come, maybe just not on a detailed part. IFRS 15. I was surprised when I went through the examiner's comment. What is it? Take note, before IFRS 15, we had IS 18, which was 11, then also IS 11, construction contract. I know some of you, maybe when you passed FA, you learned IS 18 and the IS 11. The latest standard, not only for exam purposes and in practice, IFRS 15, which is 11 from contract with customers. Now you have to understand, when say 11 is the income which will be driven from the day-to-day line of the business. Then when say contract, because of course it's a contract, it's between the two parties. From where? Customer. So this standard is from point of view who is providing goods or services. So what's the guidance of IFRS 15? There are 5 steps which you must follow before you recognize revenue. We are going to say I've included one question which we'll go through. Hope it will be more interactive. 1, you must identify a contract or contract with customers. So you have to know, have we entered into a contract or contract with customer? 2, you must identify separate performance obligation. When say performance obligation, what have you promised a customer? Have you promised a customer a machinery and also service? Okay, but I think there's someone who's not on a mute. Okay. We are trying to go through IFRS 15, which is the revenue from contract with customer. So we are saying there are 5 steps which you must follow. 1, identify a contract or contract with customer. It can be 1 or 2. Then identify separate performance obligation. When say separate, what have you promised a customer? Have you promised to sell a vehicle, or is it a vehicle and service? Then the next one, you have to determine the transaction price. At how much are you going to transact, which can either be fixed or variable. After that, you allocate. What are we allocating? You must now allocate the transaction price to the performance obligation, mostly at this level, based on what we call standalone selling price. There's an example we are going to go through. Then the last part, recognize revenue when or as you satisfy the performance obligation. When say when, some performance obligation be only certified at once. For instance, you have sold a motor vehicle. You have done what you promised the customer. So in that case, you recognize it immediately. But for the servicing, you'll be servicing over the period of time, like 3 years. So in that case, you can't recognize the revenue at once. You are going to recognize as you are satisfying the performance obligation. There's a question we are going to go through. IFRS 13 is on fair value. You must know the definition of the fair value. If it will come, please define fair value, get at least 1 or 2 marks. Fair value is a price that will be received. Hello? Am I audible? Is there someone trying to respond? Hello? Hello, am I audible?
Hello, Mr.
Yes,
Okay.
Honorable.
Yes,
sir.
audible. I'm temporarily going to mute you. You unmute yourself so that we avoid the other voices we are getting from the background.
Okay. Okay, noted. Okay. Am I audible? Okay. Hello?
You are audible.
Okay, thank you. So before that, we are discussing IFRS 13, which is on fair value measurement. So if IFRS 13 will come, ensure first you define what is fair value. So fair value is a price that will be received to sell an asset or pay to transfer a liability. in an ordinary transaction, you are not forced in an ordinary transaction between market participant at measurement date. Please ensure that you know that definition. Apart from that, fair value is what we call market-based, not entity-based. So it's a market which is going to determine the fair value. So the meaning here, I may have a phone, maybe according to me, the fair value is 20, but the market will dictate that is 3. So based on that, you must also devise the types of market. There's what we call principal market, which same as main market, where most transaction takes place. Also is what we call most advantageous market. So ensure to devise the types of market and also active market. Then IFRS 13 uses what we call exit price, not entry price. Meaning what? Not at how much I'll pay to buy an asset when the asset is coming to the business, or how much I'll pay to get a loan, but it's when I'm selling an asset or transferring. So they may ask you, what's the meaning of exit price or entry price? So at a time we are exiting, the asset is exiting the business. That's the meaning. IFRS 16 is highly examined, and you are going to see when I go through the examiner's comment. So what are you supposed to know? You must know a lease. A lease is basically a contract. It's a contract where the lessor is the legal owner, is going to convey or transfer a right of using underlying asset. So when you are defining a lease agreement, normally I like mnemonic. You can use CAPC. Hope someone can remember. So what is CAPC? So basically I say this is an agreement between the lessor and the lessee, where the lessor will conveys to transfer, not the asset, but the right of using underlying. Underlying is which asset? Is it the asset which is in Kamwala or Chilenje? Then for a lease period, we have to know, is it for 2 years or for 3 years? Then in return, there should be a consideration. So my humble appeal, if leases will come, ensure that we define a lease. Then you have to know, in short, in the exam, they won't ask you the lessor or a lessee. A lessor is the legal owner. A lessee is the one using the asset. Now, in the books of where a lessee, the one who's using the asset, if the common language will call it landlord or landlord. No, I mean a tenant, the one who's using the asset. According to the new standard, before IFRS 16, we had the IAS 17. Now, in the new standard, if you are a lessee, the one who is using the asset, there is no operating lease and finance lease. Always recognize a right of using the asset. Apart from that, also lease liability, except if it's a short-term contract or the asset involved is of low value. In that case, you have to expense rental payments on a straight line basis. That is very, very important. But in the books of a lessor, the owner, who may call landlord or landlord, if you call landlord, that's not an acceptable terminology. You have to know the terminology is acceptable. So the terminology acceptable here is a lessor. So in the books of a lessor, the accounting treatment will depend, is it an operating lease or finance lease? If it's an operating lease, the asset will continue appearing in the books of a lessor, then only account for rentals on a straight line basis. But if it's a finance lease, we are going to apply substance over form, because under finance lease, substantial risks and rewards have been transferred from the lessor to the lessee. So in substance, there is a sale. So if it's a finance lease, the asset must be derecognized. You must stop showing the asset in the financial statement. Instead, you recognize a net investment in the lease or this receivable. IFRS 16, highly examined. It's one of the entertainment area. You are like to be entertained in the exam. IAS 12. Whether you like it or not, if published or company will come, there will be IAS 12. It's one of the technical standard, but you have got no option. You must understand it. So IAS 12 is income taxes. So it covers the current tax and the deferred tax. Now, when say current tax is a tax payable or recoverable in respect of trading activities or taxable profit. If you have got a taxable profit, you are going to pay tax. If it's a tax loss, it's a credit. So in the exam, that's where there's a confusion is. When say current tax, same as corporation tax. In practice, you estimate the tax at the beginning, then be making quarterly payment. Then at the end, you compare what you paid and what you're supposed to pay. But IS-12, it operates on the principle that you estimate a tax at the end. That's why normally there's a confusion for those who are in practice or those who are doing taxation. Then you come to IS-12. So IS-12 requires that you are going to estimate the tax at the end, like the 1st December 2025. That's when you are going to estimate all the tax you pay is 100. Since we are simply estimating 100 at the year end, you take the same 100 as an expense in profit or loss, then you present it as a current liability. If you estimate a tax income or credit, then you take it as income, then you show it as an asset. Then you have to check under or over provision for previous year. So if it was under, you add back. If there was over provision, you less. Apart from that, there's deferred tax. Please spend time on the deferred tax. Deferred tax is a tax on a temporary difference. So watch out in the exam. They can give you a temporal difference. We're going to say is one question I have included. So to get a deferred tax, we have to multiply a temporal difference times the tax rate. Now, what's a temporal difference or temporal difference in simple term? It's simply a difference between the accounting value and the tax value. Accounting value, may call it accounting base or the carrying amount. Then when you say tax value, you may call it income tax. Now we have got two types of temporal differences, what we call deductible. When say deductible, it means in future you are going to have a deduction. So when you multiply, you are going to have a deferred tax asset. Then if it's taxable, we have not yet taxed you now, then we'll tax you in future. So the taxable temporal difference is whose future effect will result in the deferred tax liability. So the challenge should be there, which you have to revise. How do we determine whether you have got a taxable or deductible? But you are going to see most in financial reporting, they will help you. They will tell you the company had the taxable temporal difference or deductible. So the message, what's the message? If they will give you a temporal difference, that's not a deferred tax. Same as salary and pay as you earn. It's not the same thing. Pay as you earn is a tax you are paying on your salary. So like of temporal difference can be referred to as a salary. Then the tax you pay is what we're going to as a deferred tax. Now, how do we operate? We use what we call financial position approach. First, to determine the closing balance, which will go to financial position, and normally we present under non-current. Take note, it can be non-current asset or non-current liability. Then the movement is normally what goes to profit or loss, except if the deferred tax is in respect of the item which was reported in OCI. In that case, we take to OCI. There's also one question we are going to revise, which I picked from September exam. IFRS 3 is business combination. Whether you like it or not, you meet vis-a-vis on 18th December. Hope you can recall my voice when you be in the exam. So that you meet. It's a leakage I'm giving you. It is the IFRS 3. Because why is it a leakage? It's in the syllabus. So if it's in the syllabus, why should it not be examined? So IFRS 3 is on business combination. So what's I mean when I say business combination is where there will be acquirer and acquiree. Always there must be one entity buying another entity. And the requirement is in the books of the acquirer must compute goodwill. That's why I will try to demystify goodwill. Apart from that, all assets and liability must be measured at fair value. So you are going to have those fair value adjustment. And you are going to see there will be some asset or liability which we are not recognized in the individual accounts, but which we are going to recognize from point of view as IFRS 3. So I picked also a good question from last sitting for CA2.1, section part B, we are going to go through. IFRS 10 is on consolidation, how to consolidate. For financial reporting, unless otherwise, if there will be 3 companies, the first company will be a parent. That's why sometimes you wonder, someone getting 0 on consolidation. The first company will be a parent, the second one will be a subsidiary, then the last one will be an associate. For the past, I don't know how many, 15 years or 20 years I've been lecturing, I've never seen where they have swapped. But one time, maybe the examiner will swap. But again, we try to be consistent. So the first one will be a parent company who is supposed to apply IFRS 10. So before consolidating, each entity has to prepare its own financial statement. Then at the end, the parent, according to IFRS 10, it's a parent who must prepare now consolidated financial statements. Consolidated simply means you bring together the results. Why are we bringing together? Because we are going to see a parent and subsidiary as a single economic entity. Apart from that, the way it can come in a theory, when can you exclude a subsidiary from being consolidated? You can only exclude it where you have lost control. As long as you have got control, you must continue consolidating. Then how do we consolidate a subsidiary? We use what we call full consolidation, where we consider a parent and subsidiary as a single economic entity. So you simply asset and liability, after canceling intragroup balances, there's a question number 10, which we'll go through. After you cancel intragroup balances, asset and liability, you simply add it together, irrespective of the ownership. Now, what does it mean, say irrespective? Even if the parent owns 80%, when you come to consolidate, you consolidate everything, not only 80%. Then when you come to equity, share capital, please, share capital only pick for the parent company. The only time you are going to adjust the share capital, like the example I've given you in one of the questions, should be number 9, is where there was a share exchange and it was not recorded. That's the time now you have to adjust the share capital and share premium. Then, apart from that, the last part here, it will be an associate. How do we consolidate an associate? We use what we call equity accounting. Now, before I can go to an associate, when we go to income statement, if they'll bring income statement, watch out, mostly like what came for D8, it will be less than 12 months. Like should be 8 months what came in D8. So when you come to account for the result of the subsidiary, you time a portion. You only get 8 out of 12. You time a portion of the result of the subsidiary. Then before you can start consolidating, what are we supposed to do? You have to eliminate intragroup item. The meaning, like they will tell you, the parent sold goods to a subsidiary worth the 20 kwacha. So it means in the books of the parent, you remove from the revenue, since they indicated as a income. Then in the books of the subsidiary, you remove from the cost of sales. So what's the message? Any income or expense within the group, that one must be removed. Only show income and expense with outsiders, because a group we consider to be a single economic entity. After that, then you simply add it together. Again, no need of multiplying by the percentage of ownership. After you add it together, then you have to do what we call reconciliation or attributable. Then you have to tell us how much is profit or loss is attributable to the parent and NCI. I think that's the last question we'll go through, which I've already prepared. IFRS 11 is a joint arrangement. In a joint arrangement, there is a joint control. And again, there's a joint control. When it comes to the decision, it requires what we call unanimous consent, where the parties involved have to agree. Then we have got 2 types of joint arrangement. There's what we call joint venture and joint operation. Joint venture is where you are going to form a separate entity. The joint operation, you may or you may not form a separate entity. Now, how do we consolidate a joint venture? In a single entity, account using IFRS 9. Then when we are consolidating, use the equity accounting, the same way we consolidate an associate. Then when you come to joint operation is where you haven't formed a separate entity. In that case, in both separate and consolidate, account for it line by line. Now, what's the mean when you say line by line? You account for income, expense, asset, and liability. Then you get a share. Then what is IFRS 12? Is simply disclosure of interest in other entity. So tell us where you have invested and what ownership you have and where is it based. Why do we disclose? Is to give more information to the users. That's about IFRS 12. So just disclosure. This one may not like to be examined in financial reporting, maybe advanced financial reporting. So disclose, tell us where you have invested. IS-27 is separate financial statement. Basically, is how the cost of investment in the subsidiary will be accounted for. So according to IS-27, it can be at cost, fair value, or equity accounting. But for financial reporting, normally what's tested is at cost. But we're going to say later on, when you come out advanced or SBR, you can use a fair value. So you may find there'll be gains or losses which were accounted for, which you have to reverse. IS-28 is investment in an associate and joint venture, where we use it in an associate. So as I indicated earlier on, the last company will be an associate. So please don't start adding line by line as future subsidiary. The other name for equity accounting is a single line, meaning what? There will be only one line, share the profit or loss from the associate. That's all. In financial position, just go investment in associate. Then in OCI, share of other comprehensive income for the associate. So take note, the first company, the exam will be writing on Monday. I've given you a leakage. It will be a parent. Account for everything after adjustment. The second company, it will be a subsidiary. Then the last one will be an associate. So here, use equity accounting. Then here, use a full consolidation. But later on, you are going to see, when you come to advanced or SBR, you may find you have got two subsidiaries. You may have a D-shaped, you may have a complex. Under non-current asset, whether you like it or not, there will be IS-16. If there will be no IS in the exam you write, then I wonder. Why? It's a practical standard. In organization, there is IS-16. So whether you like it or not, you are going to meet with IASC 16. So what is IAS-16? Is property, plant, and equipment, PPE. Normally, I refer to it as your NRC. This time, it's about with time of voting, then you forget your NRC. You miss something. So my humble appeal, ensure to understand IS-16. So IS-16 is PPE. So what are the key areas? You have to know what is PPE. These are tangible assets we're expecting to use in business for more than 1 year. After knowing that, so the keyword tangible, then expected. The example, you may buy a laptop that you expect to use for more than 1 year, but someone, maybe it may be stolen or it may be damaged. The keyword there, we expected, or we did not buy that laptop with the intention of selling. After that, you have to know when should you recognize. To recognize is to include the financial statement. There are two things you must come. They can ask you, what are the recognition criteria of PPE? There are two. One, it must be probable that you receive economic benefit. Then the cost or amount can be measured reliably. Then from there, the recognition. When should you stop showing? Is when it's no longer meeting a definition of an asset. For instance, you have disposed. When you dispose, you have to de-recognize. Recognize is to remove. So in the exam, they can tell you the company sold a motor vehicle, but still appearing in a financial position. So that it's wrong. So what are we supposed to do? You de-recognize. Apart from that is the measurement. Measurement is assigning or attaching a monetary value. Remember money measurement concept? We are not interested how many vehicles you have. What's the value of the vehicles? So when you go to measurement, is what we call initial measurement, the first time. Like today, assuming you're going to buy a phone or a laptop, how are you going to come up with the value? So initial measurement, we measure at cost. Now, what is cost? That's very, very important. Cost is a purchase price plus other directly attributable cost. The example, me, I'm based in dollar. I may buy a laptop in Lusaka for 10,000. Then for that laptop to come to Ndola, I have to pay transport, maybe to Power Tools for 100 kwacha. So if I had not bought a laptop in Lusaka, I should have avoided that cost. So what's the message? Initial measurement, you measure at cost. Now, what is cost? It's a purchase price plus other directly attributable cost or associated cost. The example will be transport cost. Apart from transport cost, it may be the borrowing cost. When say borrowing cost is where you have borrowed, then you have used the money to buy the asset. So how are you supposed to account for the interest? You have to capitalize. So when you say capitalize, you add. Then apart from that is the decommissioning cost. You may find at the end of the year, you are going to incur some cost. What are you supposed to do? You add it. Of course, apart from that, they may also give the issue of like tax. If it's refundable, you're not supposed to pay because you'll be refunded. But if it's non-refundable, you have to add. Take note of that. Then IS-20, it's a accounting for government grants and disclosure of government assistance. It came in DA8. When say grant, there are conditions which you have satisfied or you have to satisfy in the future. When should you recognize a grant? When there is reasonable assurance that you are going to receive a grant and also you are going to comply to the condition. Now we have got two types of grant. There's what we call revenue grant and capital grant. Revenue grant is the grant we are going to be given to do with the day-to-day learning of the business. Like maybe I'm at Zambia University College of Technology. You may receive a grant maybe to pay salaries. That's a revenue grant. Then when say capital grant is a grant you are going to receive to do with the capital expenditure or non-current asset. So like Zambia University College of Technology may receive a grant to construct a lecture theater. So that's what we call a grant. So in short, also you revise the presentation. IS-23 is a borrowing cost. It's against one of the key standard IS-23. So what are we expecting if it will come IS-23? Borrowing cost, we are trying to appreciate when say interest and borrowing cost. Is it the same? No. Borrowing cost is interest plus other cost you are going to incur in respect of what we call qualifying asset. They can ask, what is qualifying asset? And remember when it came in CA2.1, the answers which came from student is an asset which is qualified to be an asset. I say, oh my goodness. When say qualifying asset, we are referring to an asset which will take substantial period of time before it's ready for its intended purpose. So be prepared if IS-23 will come, know the definition of the borrowing cost, know what's the meaning of qualifying asset. Then the next item is, how do we treat borrowing cost? Eligible borrowing cost in respect of qualifying asset must be capitalized. When say capitalized, you debit or you add to an asset. Now the message is, when should you commence? When should you start? There's a mnemonic A, activities are taking place. Works have started. So in the exam, they can tell you, the company borrowed in January, but activity started on the 1st March. So start in 1st March. Apart from that, the borrowing costs are being incurred. So where you borrowed, you have started incurring the cost. Then also expenditure is being incurred. So when you start using now what you borrowed. So for financial reporting, it will come 3 marks. They'll simply say, what condition must be there for a company to commence capitalization? They say activities are taking place, borrowing costs are being incurred, expenditures being incurred. But for those who may be doing advanced or SBR, they won't bring a direct question like that. They will tell you the company borrowed in January, expenditure started there. Then after narration, then you advise or you discuss. So take note of that. Then you have to know when it says specific borrowing is when you borrow specifically for the project. So in that case, you simply multiply the percentage they will give you, then times the amount you borrowed. Then of course you time a portion. If it was 9 months, on take for 9 months. The rest you expense. 38 is on intangible asset. Those assets with no physical substance. In order for you to account for the asset under intangible, it must be identifiable. When it's identifiable, you can acquire or dispose this asset without necessarily acquiring or disposing the business. What other areas are they like to test you is how do we handle research cost? Research cost, the cost you are going to incur when you are researching, we always expense. So when you say expense, you take to profit or loss. What about development expenditure? You start developing something after research. So development expenditure, we capitalize upon meeting the criteria or condition. I remember in the chief examiner's comment, some students, they felt even to what? The condition must be there for you to start capitalizing. What's the message? Research cost, expense. When say expense, take that expenditure to profit or loss. What about development cost? Development cost can be capitalized when it meets the mnemonic. So argon is in the exam, you remember pilot, but I don't know what it stands for. So it should be probable that an entity will receive economic benefit. Then you must have intention to complete the project so that you can use it or you can start, you can sell. So I always encourage you, even ask students who are here, please have intention that you have to complete Zika, CA or D8. Now, some of you say, just for the sake of time, I'll stop it. How are you going to get the economic benefit? So you must have intention, just intention to complete the project. Because if you have got no intention, you are going to abandon the project. Then onlookers will be laughing at you. We told him or we told her, you can't manage Zika. Have you seen? So please there are those who are waiting for you to fail or to quit Zika. Please, you are not the only one. There are those who have passed. It's just a matter of time. Then you will graduate. Then, of course, the expenditure can be reliably measured. Other books they use as for resources. Then you must have the ability to use or sell the asset. This is what I always encourage also for you student. Please, may I tell my student, I should not waste 6 months or 5 months teaching you only for how to gain marks for 3 hours. After you pass 3 hours, then you'll be blank. Last week, I was interacting with one of the finance manager in Lusaka. He say, hey, we interviewed a graduate, didn't know even what is IS 16. So what's the meaning? You must have the ability to use or sell the assets so that you can receive the economic benefit. They should be technically feasible where it's reached an advanced stage. Then as I indicated, mostly E and R will use them interchangeably. So you can say the company needs to have enough or be to generate enough resources so that you can complete the project. So take note of that. Then instead of saying depreciation, here we indicate amortization. Instead of depreciation, here it's amortization. So when should you commence amortizing? When the asset has been substantially completed or it's ready for use. Then we only amortize intangible asset with the finite useful life. Those with determinable useful life. Those with indefinite useful life, those are not amortized. Instead, you conduct annual impairment review. IS 36 is on impairment. What is impairment? Is where the carrying amount is more than the recoverable amount. Now, why are we concerned with the impairment? We have to ensure that the asset is not carried above what you can recover. The meaning, if you are carrying the asset at 10 kwacha, then you can only recover 8. It will be wrong for you to continue showing the asset at 10. Why is it wrong? Because you are going to overstate the economic benefit. So in this case, you have to make an adjustment by 2 so that you show the asset at 8. So what must you prepare for as you are waiting for 80th October? 1, know the definition of impairment is where the carrying amount is more than the recoverable, where the carrying amount is more than the recoverable amount. Then apart from that, you must know what is the recoverable amount. It's the higher or the greater value in use and fair value less cost to sell. Apart from that, the requirement of IS 16, at the year end, you have to know or assess, are there signs or indicators of impairment? When you see there are signs, then you conduct impairment review. Impairment review is simply a process of comparing the carrying amount and recoverable amount. There are only 3 assets where you have to do annual impairment review. What are those? 1, purchased goodwill. 2, intangible asset with indefinite useful life. Also intangible asset which is not yet ready for use. Then also ensure to revise a CGU, cash generating unit. There are some assets which cannot generate independent cash flows. You have to use in collaboration with other assets. So how do you allocate impairment loss to a CGU? You start with the specific asset which has been impaired. From there, then you go to goodwill. Then assuming you have got remaining an impairment loss, then you prorate on the remaining asset. But you must not reduce any asset below its recoverable amount. So it can be told the computer is damaged, but can be sold at 6 kwacha. So you cannot reduce below 6 kwacha. Then IS 40 is the investment property. In account, when you say property, we refer to land and building. So when you say investment property, we refer to land and building. So when you say property, we're referring to, instead of getting benefit through usage, you get benefit through rentals or capital appreciation. So if you have got the house which you are renting out, that will call investment property. So if it will come, one, recognition is the same as IS16, when it's probable that you are going to see economic benefit and the cost can be measured. Initial measurement, same as the IASC 16. How do we measure initially? We measure at cost. Where there's only the difference is subsequent measurement. Subsequent measurement, you can use a cost model or fair value. Now, when you are using fair value, there is no depreciation. That's first point. Two, if there will be a gain or loss, you take to income statement, not to other comprehensive income. Then apart from that, you have to determine the fair value at each reporting date. The last IS 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 41, which is on agriculture. So if you have got intention to be working for the farmers, Africo, Zambif, fall in love with IS 41. So what are the key things there? You must know biological asset as a living animals or plants. Then also you have to know agricultural produce. IS 37 is on provisions, contingent liability and contingent asset. So ensure that you know the provision, which is the liability of one certain timing or amount. And when are you supposed to make a provision? There are three things which must be there for you to make a provision. One, it should be probable that there will be outflow of economic benefit. Two, the cost or amount can be reliably measured. Then three, there must be a present obligation. When say present obligation, it can be legal, required by law or contract, or it can be by constructive. So when say constructive, we are referring to, because of the past practice or conduct, you have created a valid expectation. You are going to see, there's a question which came in D8. I've picked that question. We'll go through in terms of restructuring. So that's about in terms of IS-37. Then IS-1 is a presentation. This standard talks about how to present a financial statement. The key thing, you have to know the formatting. Now, most of the questions comes from students when they call me. Mr. Amson, have we done published IS-1? Yes, then I'm not coming. No, IS-1 was just given the format and the content. How to be getting the figures? You must refer to other accounting. That's a misconception. That's why I wonder, some lecturer, first day, you start balancing, start publishing. No, that is confusion. Anyway, it can work, but you simply memorize. If you want to appreciate published or company, ensure that you demystify the standards. After knowing the standard, because each note will test a specific standard, then you come to published. So just know which item are reported in other comprehensive. IS-2 is inventory. The key message, you measure total of cost and net realizable value. IS-8 covers 3 areas: accounting policies, estimate, errors, and definition. So there are 9 areas you must know in terms of definition, example, and treatment. What is an accounting policy? An accounting policy are specific rules, principles, convention, practices, which an entity is going to adopt and use as they are preparing financial statement. So when do you need to come up with an accounting policy where there is an alternative way? Like we're going to see NCI, you can use fair value or proportionate. So tell us, the exam you're going to write on 18th December, they will tell you the company are using fair value or they are using proportionate. Otherwise, there'll be confusion in the exam. Now, what will guide you to come up with an accounting policy? Refer to the accounting standard. You can't come up with an accounting standard which will contradict with an accounting policy. That will not be acceptable. If there's no accounting policy, you can refer to the conceptual framework or other guidelines. If you change an accounting policy, then you change it retrospectively. When you say retrospectively, we assume we have been using this standard sometime. Then also, it covers an error. Now, an error simply means can be an omission, misstatement, or misrepresentation of financial information. Now, which errors are we concerned with? We are concerned with what we call prior period errors. We are in 2025, then we discover the error which happened in the past. As long as the error is material, it must be corrected. Now, how do we collect, or instead we collect retrospectively? So you adjust the previous figures. There was excellent question which I came across for CA2.1. I've picked it. We'll go through. Then the last point is an accounting estimate. An estimate simply an approximation, or the method you are going to come up to use to help you to come up with the carrying amount or the value of the business. The example of an estimate is like depreciation rate, straight line, reducing balance method, provision, taxation. We simply estimate. Now, when you are estimating, you use the available information. Now, if the information on which you base the estimate changes, also you have to change estimate. So estimate is subject to change. Some of you, when you started in June, you said, no, I'll finish the syllabus and pass paper by November. Now, obviously, we have only remained about 4 days. Have you finished the syllabus and past papers? Then if not, then make some adjustment. It's never too late. Now, when you change an estimate, we change prospectively. Means what? You go, prospective means it's in the current year and future. Take note, accounting policy, prior period error, retrospective, we go backward. But accounting estimate, like if you have not been studying, forget about October, September, focus between the remaining 2 weeks. So estimate, we change prospectively. So in the exam, what are you expected? To define accounting policy, estimate, and errors. The other thing they may ask you, how you change or restate, is it prospectively or retrospectively? Apart from that, it's a definition, so you must know the definition. IS8 covers it's events after reporting period, and this is one of the highly practical standards. So you must know what is adjusting and non-adjusting event, and how do you account for it? That is the IS10. I've picked one question. IS21 is the effect of changes in the foreign exchange rate. Now, the way IS21 is examined for financial reporting is at individual stage. Like the example, Zika has got no subsidiary, but they can buy a vehicle in dollar, or when they are printing their exam outside, maybe they pay in dollar, or they can get a loan in dollar. So now, but to find Zika, they present in what? In kwacha. So they guide us how to translate those transactions. When you come to advanced financial reporting or SBR, there they can test you also at group stage. When it's a group stage is where I've got a foreign subsidiary, like I've got Dangote Zambia, Dangote Nigeria, they are using different currencies. How do we translate? IS3 is earnings per share. It's the only ratio with the standard. We want to know how much we are earning on each share. Then there's what called, this is only for listed company, but if you're not a listed company, if you want, you can also apply to IS3. Then you have to know the basic earning per share and diluted earnings per share. Basic earnings per share, you simply take into account existing earnings and shareholders. But dilutive is what may happen in the future, where you take into account what you call potential dilutive shares. IFRS 1, take note there's a difference. IAS, when say I've seen in the exam student really swap. When say IAS, International Accounting Standards, these were the area standards which were developed. IAS, International Accounting Standards, which is from IAS 1 to IAS 41. There will be no another standard. So the last IAS is 41. Then the new series of standards which are being developed are the one we refer to as the IFRSs. So what am I trying to appreciate? IS1 is the first time adoption of IS1 is the presentation of financial statement, but IFRS 1 is the first time adoption. So I'm just trying to appreciate there's a difference between IAS and IFRS. So IFRS here is a first time adoption. You have been using other standards, then you want to start using international accounting standard. Are you just going to wake up and say we have adopted the standards? No. You have to ensure that you are prepared in terms of what? You are prepared in terms of the resources. Do you have the competent staff? Do you have enough time before you can adopt it? That is IFRS 1. When you go to IFRS 5, it covers two things: non-current asset held for sale and discontinued operation. So when say non-current asset held for sale, we refer to those assets where the carrying amount will be realized principally through disposal rather than continue using the asset. So you are going to see there are conditions which must be satisfied there. One, the asset must be available to be sold in its present or current condition. Then the sale must be highly probable. It's more likely to happen. How? Then there should be active program to allocate the buyer. You have to sell at a reasonable price. Expect to sell within 12 months. Now, when you classify the asset as held for sale, that asset should not be subject to depreciation. You have to stop depreciating. Then you present under current asset. Discontinued operation. Now, student mostly take note IFRS 5 covers two areas, non-current asset held for sale and discontinued operation. From my past interaction, students are comfortable with non-current asset held for sale. So what's a message for you? Revise, discontinue the operation. Now, what is discontinued operation? We say it's a component or part of the business which has been disposed or classified as held for sale, and it must present a separate measure line of the business. So take note, before you write your exam, revise the IFRS what? Revise IFRS 5. IFRS 8 is about operating segment. So you have to know what's an operating segment. It's a component of the part of the business which is regularly reviewed by the chief operating decision maker. Then it engages in business activities where they are earning income and also incurring expenses. Then the last one, discrete or separate financial information is available. Then from there, we have to know what is a reportable. Before it can be a reportable segment, then it must be operating segment. Then apart from that, it must pass at least one. So these are the key areas. I'm not saying only. Hope the message is clear. I'm sure the institute will share with you. I've prepared a summarized item which I examined. Then these are which I've picked are the key areas you are likely to meet. In terms of examination, preparation or techniques, there are 3 areas before, just before the exam, during the exam. When said before, when you started from, I don't know, from July up to somewhere September, you must ensure that you know the syllabus. That's why for me, always I have to ensure that I cover the entire syllabus. Why? I know the exam will come from the syllabus. When Zika gives exam to someone to prepare, there's what we call syllabus mapping. They have to show Zika that all areas have been tested. We do not want only to produce accountant who only know how to prepare statement of profit or loss. They don't know cash flow. They don't know IS-21. No. So the message, it's never too late. The institute is going to share the examined areas which I've highlighted, ensure to go through all the areas because the question will come from there. I've given you a clue. When they give someone to prepare, they will tell them, ensure that all the areas are covered. So check your syllabus and also take in terms of the weight. Then ensure what chief examiner's comment. This one area, I was asking someone who's writing exam in December, have you gone through the examiner's report? No. But for me, I'm not writing the exam. I've gone through the examiner's comment and I've learned a lot. So please, sometimes when you fail some maybe exam, don't blame yourself. Try to understand where did you go wrong. So basically, chief examiner's comment is more of counseling me. Because I know up to now, some of you say, no, Zika just made me to fail. I passed. You haven't told the stakeholders. Me, I passed. Zika, they are building, so they want to raise money from us. No, please go through examiner's report. It comes from the markers. Why is very important? They will tell you, we're about to go through the mistake which we are making. And if I want, they can bring the same exam because one question, the pass rate was about 15%. Why can't they bring the same question? So take note, all of you, for if you're writing DA8 or CA2.1, just pick what came last sitting for DA8 and CA.1. Understand, go through suggested answers, go through the examiner's comment. I can assure you, give a testimony. Of course, start going through past papers. It will give you to what extent to be examined and how you're going to manage the pressure. Some of you are, every time you are just answering bank reconciliation as if it will come with partnership. Forget about the past. So go through the past exam papers. It will help you to what extent you'll be examined. I always encourage, form a study group. This is very, very important. You can't know all the areas, even in terms of subject. That's why there's specialization. For me, I only teach financial accounting, reporting, and advanced. I can't teach everything. Hope the message is clear. So it may be good in IS-16. That one will be good maybe in IS-3. Physical, if it's possible, COVID has gone. But if not, virtual this time, just use, you can use WhatsApp, you can use Zoom. So this time, there's no need for you to say, I've got a partner. So look for someone. It's very, very helpful. We are there to help each other, to encourage each other. But if you be alone, you'll be writing the exam under frustration. Interest is everything. If you have lost interest, you fail the exam. So have interest. Don't stand as if we are forcing you. Don't only study for 3 hours. When you pass 3 hours, you even throw the books. No. Have interest. This is your life. This is your life. So ensure to acquire the necessary knowledge, skill, which you have to come and use. Study. You can't be studying 2 hours per day. No, find time. I know sometimes we comfort ourselves. No, me, I'm in employment. Me, I've got a family. I'm a pastor. I'm whatever. No. Zika, when you be writing the exam, they will assume all of you are full-time student. And maybe you are at Zika, you are learning, which is not the case. I wish maybe if you are writing the exam, maybe in the future, Mr. Katungu Alawa, no, you attach the CV. Then you attach the CV. No, I'm a pillar of the family. So when you be marking, can you be lenient? But this time, we don't attach the CV. So find time to start. Just before the exam, give enough time. I've seen you are writing at 9 hours, you are studying from 01 up to 8 hours. No, you'll be tired. In the exam, you need to have energy. Then also, this I'm at a center, I'm at Zambia University College of Technology. This is normally I experience. Student to be coming, no, sir, there is no power. So can you help me to print? I said there's no printer. Someone start running, no, I'll go to town, then you waste your time. So this is a simple issue we try to advise you. All of us know there's load shedding. We don't want to start panicking. So I'm expecting by next week, print. Now, some of you are waiting, you'll be writing on Monday, you're waiting Sunday after church. Then you start panicking. Because once you start, you are in a panic mode, you forget. So I hope I have guided someone here. No one will come to my office if you are from Dollar. That means Samson help me to print a docket. Also, as I've indicated, Zoot is examination center. Most students, they don't have time. This time they are construction like in Dollar. You will take 1 hour, then you reach that. So go in good time and ensure that be ready to answer the entire any question from any part of the syllabus. Because some of you start interceding. No, I'm hoping cash flow won't be there. I'm hoping consolidation won't be there. No, please, you are not there. So you are not the examiner, so be prepared. Because once you see a question which you didn't start, you'll be demoralized. During the exam, manage time. I've seen a student to do well, question 1, but they fail to attempt section B. So on average, what do we recommend? 1.8 minutes per question. Plan for it, allows none at all time. Also answer the required question. We haven't said all the questions. I'm supposed to answer 4, answer 4. It will make a difference you get even 2 or 3. My humble appeal. Then I always receive a question. Should I start with consolidation, section A or B? Start with the area which you are comfortable because it will give you confidence. But just ensure to manage time. The key thing when you be answering, right on top. So can this question should be when you open a page, should even say question 5 should be on first page. They won't say, why did you start with section A? So start with the area which you are comfortable. It will give you confidence. Confidence is a fuel for success. Then need 3. No, when you are writing, I know even myself, I don't have a good handwriting, but let's try our best so that the markers, they will be able to mark. Then I've been a consultant for Zika for some time. Sometimes we laugh when you see some comments. If you say, come and see the comment, only God alone. God bless the marker. I am an orphan, I was sick. Those will just waste time. I know some of you even maybe give it a what, you testify, no, I wrote actually that one. No, I don't know, I'm just from my past. These are the common thinking, you want to play with the psychology of a marker. A marker is a lecturer, is a teacher. When you say, God bless the marker, then you feel the marker is going to have put on you. No, it will just mark you, even if, hope the message is clear. So I should not see this comment in the exam. You just waste your time. During the exam, attempt every part. Like the way it came in for this September exam CA, there was a theory part. And when I was going through examiners comment, they said, student did not answer B. They only answered the A. Then please don't do calculation in your head or calculator. Write down. Let a marker sees the figures. Okay. This is now the mistakes from those who attempted in September. I hope after this presentation, someone will give a testimony. I'm one of those who made that mistake, and I'll be very happy. Or someone will be delivered. If it's a man of God, someone after this presentation must be delivered from the spirit of zeros. If the academics say they will sort you out in terms of zeros. So I'll simply go through why. This document is on the website. If you don't have work and say, just Google Chief Examiner's comment, it will come. Zika, they have really been helpful. So I'll simply highlight, but what I recommend, go through the entire question paper and the answers and the entire Chief Examiner's report. Question 1, it was on a consolidation. They brought a statement of financial position. The lowest got half mark. Honestly, how can you get 0 or half mark? I have told you, the first company will be the parent. If you want, just get the parent and subsidiary, start adding together, provided you are showing without even any adjustment. You can't get 0. Every mark is half entry. So this one means only the entered one figure. I've told you, share capital, you pick only for the parent. The retained earning, you see as per question. Now, how can you get 0? I think it will, in all fairness, this one should have done better. Then you complain, no, Zika is the one who made me to fail. No. Next one, the examiner was very happy that students are now showing the workings, because in the past we have been seeing about this. Don't please show workings. Then post as many entries as possible. For me, that's what I tell my student. It's not about balancing. Please, you want to balance. You are not the one who's going to prepare the exam. So what's the message? Enter as many correct entries as possible. I want to tell you, they won't give you the mark for balancing. They won't give you the mark for totals. So aim for entry. So they were very happy to see that now there's this improvement, because we have been seeing about this where students, they want just to focus in terms. First, they compute good, they go to next. No, it's about entry. In this question, there was a fair value adjustment. Remember when I propounded the IFRS 3? The acquirer must measure all asset and liability at fair value. So in the exam you write, there will be fair value adjustment. But in most cases, they indicate that you ignore deferred tax. But here, the examiner was from the other side. He said that adjustment, it will be treated as a temporal difference. So it means we are going to see there was a fair value gain. So since it was a temporal difference, we are supposed to multiply by the tax rate to come up with the deferred tax liability. So take note, those fair value adjustment, in most cases, most for advanced financial reporting, it will attract a tax. So we are going to see, we are supposed to recognize the deferred tax liability, which was not there. Why are we going to bring this deferred tax? Because of fair value adjustment when you use IFRS 13, or I mean IFRS 3. Another good thing which came, I remember student said, me, I made a mistake, Mr. Msonda. The good was negative, so I'm worried. No, so it has been a while when they tested the bargain purchase, the other name will call it negative goodwill. So the exam you write on the 80th, if it will be negative, we call it bargain goodwill. It's normal. So CA2.1 was negative. In simple terms, if it's to simplify, is when you use the same format to give you negative, or you pay less than the value of the business. So what are the areas they may ask you? What can bring about negative goodwill? One, it's a good negotiation by the buyer. Two, is where the seller is under financial difficulty or stress. I'm sure of you know what it means. You have got an issue. Then you can even sell your phone at 50 kwacha. Also is where the seller is not aware about the true value of the business. So apart from computing, they can ask you in terms of how to treat. I mean, what factors can bring about negative goodwill? After that, the next point is when you compute goodwill, how do we account for it? Like here, we're going to see student had no idea. Others, they ended up presenting it under non-current asset, which is wrong. So take note, if there will be negative goodwill, it's a gain from point of view as a buyer. You have paid less than the value of the business. So since it's a gain, you recognize in profit or loss as the income. Now, in this case, there was a financial position. So where were you supposed to recognize retained earning? And there is no impairment loss. So be prepared for that one. So I've talked about a bargain or negative goodwill. If you compute, be prepared what can bring about negative goodwill and where to present. So these are things immediately after this. What am I expecting? Download this question, attempt, then go through the examiners so that they will be talking to you. Now, despite what I'm saying, some of you won't even go through the examiner's comment. We continue. Again, this one was a trick part. If you come to forms of consideration, of course, we have got a number of them. It can be cash, share exchange, loan note, of course, contingent consideration, and deferred. Now, when say deferred consideration is where the payment will be made where? In future. So what we have been preaching is, for instance, you are in 2025, then you pay 25 kwacha in 2030. Now, since we are computing goodwill now, what are you supposed to do? You discount. That's the message you have been preaching. You discount, like for instance, when you discount, you find that now it's 18. So when you are computing goodwill, use 18, which you are going to debit investment and credit deferred. Now, in this question, I think I can fairly say for the past maybe 8 years, both CA2.1 DA8, even maybe 3.1, it has been, wow, they have never tested this one. So these are things we have to be careful. So what happened in this exam, they gave us a discounted, they gave us 18 instead of future value. So when say fair value is a now value. So in this case, since they gave us a discounted amount, we are not supposed to discount. We are supposed just to use 18. Then thereafter, you start unwinding or charging interest. That's a big message here. What are they telling you, the markers? Candidates needs to realize that the cost of capital, which is the effective interest, which we are provided for sake of unwinding. So there were no need for you to discount. We are supposed simply to start charging interest. Why? Because they gave you a discounted amount. This is very interesting. I would encourage you, I would tempt you, all of you, go and download, go through. It's a good question, the way it came. So I'll be very happy if the examiner can bring also the same one. Another important point, when you come to cost of investment in the parent, always you have to do reconciliation of the cost of investment. When you say reconciliation, tell us how much was paid in a subsidiary, how much was paid in an associate. So if you check this question, it failed to balance, and the balancing figure was other investment or trade or equity investment. So that's the meaning you're saying. Many candidates failed to realize. Why did they fail? They did not do reconciliation of the cost of investment, of the item of the investment in the separate financial statement, which was financial asset. How was it? It was derived or determined by subtracting all the investment. So it's a good question here. You are going to see there was other or trade investment, which was supposed to compute by reconciling. Another important point was there was a contingent consideration. Contingent consideration is a future dependent consideration. According to IFRS 3, it's not about meeting the requirement, as long as the fair value can be measured. So in this case, there was contingent consideration, which we are supposed to debit cost of investment and show it as a liability. That was question 1. It's a very interesting question on consolidation. Okay, we continuation. Further, the examiner was in shock. He was disappointed. How? Due diligence cost. Due diligence cost, we refer to the cost which the buyer is going to incur when they are buying the business. Now, the misconception is this other standard like IS-16. IS-16 requires that a directly attributable cost must be capitalized. When say capitalized, you add to the cost of investment. In the past, before IFRS 3 was revised, the standard used to allow to capitalize. So it means you compute when you're adding goodwill, Now, according to the revised standard, IFRS 3, and I've examined this several times. Now, I don't know why we miss, because we simply memorize, don't want to understand. That's why I always encourage, you can't start financial reporting 3 months. No. You know, when you come to me, I'm a consultant. Like lawyers, they even know at this case, we will lose it, but they say, no, we'll do our best. Also, I say, okay, I'll do my best, but I even know. But normally, sometimes we have to be also ethical as lecturer. Normally, I encourage my students. Me, I don't do for 3 months. I only do for what? For 5 months. So due diligence cost should not be capitalized. So most banks, they showed it as part of the investment. Instead, we are supposed to debit to retained earning. So the message, directly attributable costs, which may call due diligence costs or professional costs, should not be capitalized, should not be part of the cost of investment when you're computing goodwill. Expense or debit retained earning. However, if you are going to incur what we call issue cost, like when you are issuing shares and you incur some cost, in that case, you debit share premium. This is very important. Then there was a cash in transit. Cash in transit is where one company made a payment, but the other one did not receive. So before you can eliminate the balances, you account for cash in transit. So if the cash in transit will come, there are two ways. Normally, you accelerate the process. When you say accelerate, we assume the other party received it. So it means you credit receivable, that's reduce receivable, then debit cash. The other one is where you reverse. You reverse from point of view who made a payment by crediting payable, then debit cash. So the key message, if there will be cash in transit, simply increase the cash at bank. Then if it will be an overdraft, you adjust, then you reduce the receivable. Now here, in selected cases, consolidation was done by adding all asset and EBIT and equity for 3 companies. I have told you, I know here we don't want the spirit of doubting Thomas. We want to deliver you from zeros. The first company will be a parent. The second one will be subsidiary, unless otherwise. So here is where it's one. Use a full consolidation. You simply add it together. The last company here will be an associate. Associate, we don't add it together. Use equity accounting. So since it was a financial position, we are only supposed to compute investment in associate. But student, they went with cow feather, they added everything. Another issue, some student, they used proportionate. When say proportionate, if it's 80%, you start getting 80% of assets, 80% of rabbit. No. For subsidiary, simply use full consolidation. Then there was a share exchange, which was not accounted for. So what should have happened after computing? You debit cost of investment, then you get the share capital, excess the share premium. There's one question which I've picked. Then there was B part, which was tested in terms of IFRS 3, business combination. I've picked this one. I'll go through. Future. You are the future. You are reminded. I'm not the one who is telling you. Me, it was just copy and pasting. So if you just blame yourself, you are reminded to go through the stud theory part. Like you are going to see, there are only a few answered the theory. They were just busy consolidating computing. It's not about, we don't want to train an accountant who only know how to compute, but not able to think or apply. So take note of that. You are being reminded. Question 2 was on published or company. 64. Then someone got 0. Honestly, how can you get 0? In profit or loss, show income and expenses. There will be revenue, there will be cost of sales, there will be distribution. How can you get 0? Statement of changes in equity. Show the movement in equity. Agon is where I don't know equity. Equity is the shareholders fund. Share capital, share premium, retained earning. Tell us how much were the opening balances, what happened during the year. In financial position, start with assets. Then equity and rabbit now. So how can you get 0? So if you can just attempt this question and also D8, then we are there. Like what I said, dividend. I preached in August, but I don't know what happened. Dividend, according to IAS 32. Problem, we don't want to fall in love, to start standards. Then you want to pass. There's no shortcut. If you rush, you will crash. You will be presenting dividend in profit or loss. So ordinary dividend, if it published will come, it will be there. And what's the message? Ordinary dividend is not an expense, an appropriation. So you must debit retained earning. Hope the message is clear. Please, please revise. Otherwise, you remember my voice or recall my voice after the exam. The other one is the evaluation under IS16. Take note, under evaluation model, you have to know when the asset was revalued. Was it at the beginning, during the year, or at the year end? Because for you to know the evaluation gain or loss, you compare the carrying amount and the revalued amount. So in this case, the asset was revalued at the year end. So some student, they revalued at the beginning before charging dip. So what was tested here, we are first supposed to charge depreciation. Then we come up with the carrying amount at the year end. Then you compare with the revalued amount. That's the meaning here. The revaluation was wrong. Why? Because they forgot that it was at the year end. So since you are going to memorize this one, the exam now will bring revaluation at the beginning. After you know it, now revaluation during the year. So if you want to be comfortable with revaluation, what am I recommending? Answer one question where they revalued at the beginning, another question where they revalued during the year, and also revalued at the year end. That's a message. There was the IS12, student forgot to account for over provision. This one I've picked, I will go through. Then I said deferred tax is a tax on temporal difference. Now, problem want to memorize, not understanding. So what's the message? When you multiply a temporal difference times a tax rate or company rate, what you get is a deferred tax. So like here they're saying, when determining a tax credit for the year, further, net taxable temporal difference of 15 was stated as a deferred tax. It's like they give you a salary, then you go and tell your madam, this is a pay as you earn. No, that is confusion. So what was given here is a difference. So you were supposed to multiply 15 times 30. Then you get 45. So 45 was now a deferred tax liability, which was supposed to be presented in financial position. But most students showed 15 as a liability. So this a message, please accept and work on a weakness. Otherwise, we'll keep on blaming Zika. So they know that since now you have memorized, they'll bring 45, again you multiply. So the message, a temporal difference, when you multiply by the net, is a deferred tax. Can be an asset or liability, but in this case, it was a liability. Why? Because we add a taxable temporal difference. Hope the message is clear there. So as you'll be writing the exam on 18th December, watch out. Are they going to give you a temporal difference? Then they will give you a tax rate you have to multiply. Or are they going to give you this one? This is very, very important. Another important point, it was a common mistake. They brought redeemable preference shares. Redeemable preference shares, device IS32, I said must be presented under liability. Most students presented under equity. So redeemable, you have got an obligation to come and buy back. So it was supposed to be presented under non-current liability, but most students presented under equity. This is very important. Another issue, students were picking the wrong figures in the trial balance. It's normal. There will be pressure. The paper it will be bent. Then it will be shivering. So to help you, this is a personal advice. It's either you pick it or you leave it. But I'm advising, buy a ruler and carry it in the exam. Because you find you'll be picking the next figure. There's these simple things we tell you. It's what we come across when you are going through marking. Now, problem, you're on. Say, no, I can't carry a ruler. So these are simple issues. Otherwise, be picking. That's why go through. So can you imagine you get something wrong because of picking the wrong figure? I remember one time when I was a part of those financial accounting. Student got everything wrong. Why? Because he was missing by one line. I said, no, can we do something? Said, no. When you check the question paper, they say, pay particular attention. Are the same people, even in practice, they'll be making wrong entries or they'll be paying wrong people. So I want to teach you that you have to be paying attention. Then the other issue is where you do your working on your calculator, then you just take it there without showing the breakdown. That was wrong. Question 3 was on financial instrument. The pass rate was 15%. So I don't know if they can bring same question and you complain. And of course, someone got 0 on IFRS 9. What were mistakes? Student failed to talk about classification of financial asset, which is amortized cost, fair value profit or loss, OCI. Then the other issue, there were government bonds. Now take note, if it's an asset, transaction cost we capitalize, but students were subtracting. Then financial liability, we debit it, we less. So student swapped here. So what the examiner tested you is to know that under financial asset, when you use amortized cost, capitalize, you add. But for liability, if it's under amortized cost, you debit, you less. So that's what was tested. This is a good question. I can recommend all of you to revise. If you can revise this, then at least will be there in terms of IFRS 9. Question 4 was on cash flow, and of course, there was part of ratio. Someone got 0. It was indirect method. You simply start with the profit. It was even given profit before tax. So someone failed to get there. Then there'll be those movement and you reverse depreciation. So what were the common mistake? The cash spent on acquisition of non-current asset was wrong. Why? Because you open. Now, when you're answering cash flow, you can use a T account or ledger, or you can use a narration. Use the one which you are comfortable. So if it's a T account, opening will be on debit, closing will be on credit. So what the most student forgot was to debit asset or to add with the revaluation gain. Hence the figure was wrong. Another issue is also how much was obtained by selling shares, because we are supposed to open a share capital. They forgot that there was a bonus issue. Bonus issue is when you give shares to existing shareholders at no consideration. So what they tested here, we are supposed to create a share capital. We are trying to explain that part of the increase was due to the share exchange. So the figure was wrong there. Then apart from that, also retained earning. Why do we open retained earning? To know how much dividends were paid. Again, the dividends were paid was wrong. Why? They did not account for bonus issue. So we are guided here. Normally when there's a bonus issue, we debit share premium and credit share capital. But in this case, we are told that instead of debiting share premium, we are supposed to debit retained earnings. This is a good question. I wish to recommend everyone to go through. So the message here, dividends paid were wrong. Why were they wrong? Because they forgot to include the bonus issue. Then apart from that, also, there was a good question. They tested IS-16 and IS-7. When you revert, there is a gain. Of course, we get it OCI, then we take revaluation reserve. Now, IS-16 allows that you can transfer from revaluation reserve to retained, from revaluation reserve to retained earning, meaning you debit revaluation reserve and credit retained earning. And what's the guidance? You can transfer at once when you disposal. You can be transferring gradually each year. Now, what was tested, we are supposed to be transferring each year. Now, the issue is how do we determine the amount of annual transfer with what we call excess dip? So in this question, there was the annual transfer of excess dip from the revaluation reserve to retained earning. Again, the figure was wrong. Why? Because that was not accounted. Hence, the most of the item, then also in terms of risk, to know how much was paid, you are supposed to open a lease account. You combine both current and non-current. Then also development cost, you are supposed to open. Then taxation, where you combine both current and fair tax. Question 5 was on IS-8, 15, and conceptual framework. The performance was poor, and someone got 0. Imagine, and there was also someone got 0 despite there was the conceptual framework. So what were the issues? Lack of understanding IFRS 15, learning from contact of customer. I wish to encourage you, this is an entertainment area, it's a new standard. Then like what happened here, they sold an asset, then they were providing services, and I think they charged about 600. So what was tested here, for the asset, the amount was supposed to be recognized immediately. But for servicing, is over the period. So what should have happened here, not recognize at once, no, it's to recognize over the 3 years period. So the mistake here is the student recognize at once. Remember step 5, recognize when say at point of time, like when they sold an asset, the entire amount was supposed to be recognized. But for servicing, is as they were servicing, but most of students recognize at once. Then another issue, accounting policy. Some students indicate that you have to apply it prospectively. No. Prospectively is where we only use it for an accounting estimate, but for the policy and the prior period error, we account retrospectively. Ignorance. I don't know what you are studying, what is guiding you. I don't know if it's Holy Spirit or ancestral spirit or past papers. What must guide you is the syllabus. And the syllabus is the conceptual framework 2018. Now, why students decided to ignore it, I don't know. So I'm not the one who's advising. Me, I just picked and say I will deliver the message. It's up to you to ignore it. You are advised to understand each area. They haven't said, I don't know, Samson come to me, Samson, me, I want just consolidation, published and cash flow. No. We are not training accountant to only know those. It's all areas. So understand the syllabus and theory. We go to D8. This again is a variable in there. Someone only consolidation got 0. Then you wonder what if we are ready or we are not ready. Then what was the issue? What came for D8 is income sales. So it's a good question. CA2.1 was financial position. This one was income statement. If you can just start these two, D8, September, on CA, then you are comfortable. Why? It was income statement and subtract was only for 8 months. So item were supposed to be time apportion. Then you are going to see the parent add 70%, 75%, but student we are getting 75% of income and expense. No, we simply add. The issue of NCI will come when you come down there. We have to say profit attributable to. Then you come up how much is for parent, how much is for NCI. Then student had a challenge to compute goodwill. I've told you the exam you write on 8, there'll be goodwill. So can you go through the format? Okay. And here, obviously, it's a good question. In CA2.1, they gave us a discounted amount. But here, we are supposed to discount, but student did not discount. That's why if you know things mechanically, you go CA2.1, you pick without discounting. Again, here you will not discount. So here we are supposed to discount. Why? Because they gave you the future value. So this is a good combination. If you can answer CA2.1 and D8, you'll be more than ready for the exam as far as the deferred consideration is concerned. Then, as I've indicated, there are 2 methods of valuing NCI. You can use what we call full method or fair value. When you use this method, the goodwill compute is for both for parent and NCI. So if there will be impairment loss, you share. But some students decided not to share, maybe because they answered the question, which was a proportionate. Remember, proportionate or partial. The goodwill compute is for the parent, and there's no need of sharing. I'm not the one who is writing this. It was just a copy and paste. You have been advised, go through examiner's comment and understand so that you know the common mistake you learned from the past. Question 2 was unpublished. Again, someone got 0. And the issue, there was IFRS 16, which was on what? Leases. So remember, what came was in the books of LSC. So in the books of LSC, recognize the right of using the asset and the lease liability. And when you go through there, direct labor cost must be capitalized. Then there was I think it has been one. So let me remind you, sale and lease back is examined. When I say sale and lease back, I'll sell my house to Mr. Katungu. Then I don't want to go back to Kawambwa. Then I'll start renting that same house. That's what we call sale and lease back. So now for you to know whether there's a sale or there is no sale, you have to go to IFRS 15. Maybe what I'm trying to avoid, I simply borrowed from Mr. Katungu. Then I used my asset as a collateral security. So you're going to see there was no sale. So since there was no sale, it means we borrowed. Then we use the asset as a collateral security. So take note, it's a wake-up call. I think it has been a while when they tested sale and lease back. So go and revise sale and lease back under IFRS 15. Then, if published will come, they'll give a trial balance. There'll be a bank. This is what I always preach. So if you check a trial balance, bank will be on debit side. It's an asset, present under current asset. If it be on credit, then overdraft. Now, student, the bank was on debit, but student were showing it as an overdraft. Maybe the question they were answering overnight, it was on credit. So don't know things mechanically, understand. Those who are writing published, what's the message? There will be a bank. If it be on debit, present it under current asset. If it be on credit, present it under liability. Then student had the challenges in terms of depreciation. Take note, depreciation being the trial balance is accumulated dip. Then you have to depreciate during the year, where you can use straight line or reducing balance method. Then please, not showing workings. Question 3 was also cash flow. I was surprised when I had seen 34.5. Personally, the question which is challenging is published, not cash flow. Answer this question in D8 question, whatever 3. and the one which came with CA2.1, you won't get less than 15. Then someone got 0. Like same as applied. That's why Zika said, please, can you talk about cash flow? What were the issues? The disposal proceed. So here we're supposed to count the disposal proceed by comparing the carrying amount and the profit or loss on disposal. So it was a challenge. Then student failed to calculate dividends. In financial accounting, dividends paid normally they give us. Here, open a working for retained earning. So when you open a working for retained, where are you going to open? You want to compute the dividend which were what? Paid. So take note. I remember someone called me and said, sir, we are very lucky. This time they didn't bring dividends. What are dividends? No, please. This is not financial accounting. Always open a working for retained earning. Student, something I don't know the format. I talked about the first part would be operating, investing, then financing. That's the format according to IAS what? 7. So can you ensure that device and presenting for not the way you feel like, follow the requirement. Then student fail to know when it's not about cash flow where you feel like you have to know, is this operating? Is it investing or finance? So student could not distinguish. Under cash flow to be under operating, investing, and finance. That's why you have to know this one, is it for financing, investing, or what? Then apart from that, student failed to compute the payable to the payable one because they included accrued interest. So we are supposed to remove accrued interest and we take to computation of the interest paid. Question 4 was on IFRS 15 on 1137 provision, government grants, and international public sector accounting standards. This body is responsible of setting standard IPSAs for public sector. Or I mean for public. For private sector, we have got IASB. I remember when this question came also, students were answering about IASB. IASB is International Accounting Standards Board. These are the ones who are responsible of formulating standard for private sector, like the standard IFRS. But for government, they are using IPSAS, International Public Sector Accounting Standards. So the board which is responsible is this one. So you are going to see most students were answering IASB instead of IPSAS. They say, no, Zika made a mistake. No. And someone got 0. What other areas? IS-20 came. They failed to distinguish between revenue grant and capital grant. Revenue grant is a grant you get for operation. Capital grant is for capital expenditure. Then student IS-37, they failed to define provision. Then, of course, the theory part, they did not answer. Question 5 was on IS-21. You can see again conceptual frame came and how we measure the performance for public sector. Someone got 0. What were the issues? Measurement basis. They had asked about measurement basis. You can use a historical cost. You can use a current account. You can use a value in use. But students were answering elements. They are defining asset liability. Then IS-21 tested about monetary and non-monetary item. They were very weak in terms of attempting. Okay, monetary item is the use of the currency held, or the amount to be received is fixed or determined, or the amount to be payable is fixed or determined, like payable, receivables. Measuring performance. For instance, want to know the performance of UTH, University Teaching Hospital. Is it about a profit? No. They are, remember, public sector, they are there to provide the services. And the way we measure their performance about value for money. So we can use 3 E's: efficiency, effectiveness, and economy. So students were confused. Then they were answering as a private sector. Okay, those were the comments. So what I would encourage you, all of you, ensure to go through the chief examiner's report. It's there. Just check on the website in case you're having challenges. I think someone shared with me. In terms of published, which is likely to come. So what are some of the challenges? They may give you a trial balance, like the way it came with both exams. So they just know the element. Is it an income or expense? We take profit or loss. Asset liability, financial position. What I would recommend, answer also one question on redrafting. I've even highlighted. Normally when it comes, it's a challenge. Redrafting is where, or restating, is where they will give you the financial statement, but there are some errors or mistakes which were made. So you have to correct them. Now, for you to correct them, you have to understand the standards. Now, what the clue I can give, in case you'll be lazy in the exam, just copy and paste without any changes. You'll get at least 5. So redrafting, it will require adjustment. Now, the key message, the figures, if they will give you a trial balance, like it will come. Those entries are which are in the trial balance. Normally we enter them once. It's either it's income, expense, or asset or liability. Unless it was wrongly entered, and you'll be given half mark. Then the figures you are going to drive or compute in through the notes, they were not recorded. So you are recording. So since you are recording, record it twice. That's what will be 1 mark. Then there will be taxation. The meaning here, if it will be on the debit in the trial balance, last year we underprovided, so increase the expense for the current year. Like the one which came, it was on credit. So if it will be on credit, last year we overprovided, so reduce the estimate for the year. Then you have to know what we call coupon rate and effective interest rate. Coupon rate, same as a principal rate or nominal rate. We use to determine the annual cash flows, how much we paying or receiving. Then the effective interest or market rate is what used to discount and unwind. So in the exam, they may give you 7% and 8%. You must know how to use it. Depreciation to be the trial balance is accumulated for the past. What are you supposed to do? You compute, then you take to profit or loss, then you increase accumulated dip to come up with the carrying amount. Bank will be there in the exam if they'll give you a trial balance. If it will be on debit, current asset, credit, liability. Retained earning normally will be on the credit side. It means the company has been making profits. But the company maybe has been making losses. So in that case, to be on debit side. Watch out. To help you understand, revise March 2022, question 2. So far is the question I'm able to recall, where it was on debit side. Then, when they are marking, they are very generous. The policy of Zika, when marking, they use what we call follow-through principle. So follow-through principle meaning what? The example, you compute a profit which is wrong. Then you take the same wrong profit you take to retained earning. Here they won't penalize you twice. They only penalize you once. So the message, that's why for me, I'm encouraging you, enter as many entries as possible. Same thing, you prepare a statement of changes in equity. The closing balances are wrong. The same wrong figure, simply take them to financial position, they will mark you. I want to give you a group or int. Since I've been given the right to disclose, I have to disclose. Normally, when they are marking exam for Zika, for every correct entry is half mark. Then if it's normally theory, normally will give you 1 mark. This is very, very important. You have to know. So enter as many entries as possible. Consolidation, which will be mostly question 1. What are some of the areas that they're going to test you? Is unrealized profit. Unrealized profit, the other name we call it internal profit, is a profit or it can be a loss which was made within the group. Remember, a parent and subsidiary considered to be a single economic entity. So you have to understand what is a profit margin or markup. Unrealized profit or loss is likely to come. So we compute unrealized profit in respect of unsold inventory, those which are within the group. Then what is profit margin? Is a percentage on selling price. Then profit markup is a percentage on cost price. So if you be given unsold inventory and they'll give you margin of 20%, you simply multiply 20% of unsold goods. But if they will give you a markup, let's say 20%, you have to convert a markup to margin. You have to convert a markup to margin. So if it's 20% to be 20 over 120. Here's where I've seen there's confusion because we simply memorize. Oh, last time it was 20 over 120. Without knowing that last year it was a markup. This is a margin. Proportion to consolidation. That's a key area. Mistakes students they make. So what are we saying? Even if the parent is going to buy 80%, please add everything, not 80% of revenue and expense. Remember, I've given you a clue. The first company will be a parent, the middle company will be a subsidiary, so use full consolidation, process B as 1. But the last company will be an associated joint venture where you have to use equity accounting. My humble appeal, answer what came last sitting. You will pass the exam. The other thing, I talked about what came. Direct attributable cost should never be capitalized. You have to expense. Sometimes students ignore group structure. Like here, this exam comment came from the examiner. So for this exam, there were 2 marks just for write a group structure. You write a percentage, post period, and NCI. So if someone did not write a group structure, missed 2 marks. No matter how complicated the question will be, for the parent, share capital only pick for the parent. Asset and liability, please use not time or portion. The examiner is very clever. Like for D8, what came is income statement, where it was 8/12. So they know that if they bring financial position against them to be saying 8/12. No, please. Asset and liability should never be time apportioned. Simply pick them at the year end. Then another thing, please don't ignore, or before that, impairment loss. If it's fair value, share between the parent and NCI. If it's partial, the entire loss only adjust the return of the parent. Contingent liability, developed intangible asset, you have to recognize. Then watch out in terms of NCI. When I say watch out, you meet vis-a-vis. One, there will be 3 NCI. The NCI at the date of acquisition, so they will tell you whether you're using proportionate or fair value. Then there will be NCI in profit or loss, like what came for D8. There we are supposed to tell us how much profit or loss was for NCI. Then in financial position, we present NCI as at reporting date, where you present under equity. Then statement of changes in equity, you want to know the movement of equity, how much was NCI at the beginning, during the year, and the end. Then cash flow, we want to know how much dividend we paid. So in short, NCI, watch out. How do we come to the NCI at acquisition? NCI in profit or loss, NCI in financial position, NCI in statement of changes in equity, NCI in statement of cash flow. From my past interaction with students, we are mostly comfortable with the NCI in financial position. That's why even what came for D8, some students were using the format for financial position. Okay, that's about that. So what is remaining is now the question which I prepared. So maybe I want us to make it more interactive. So hope now maybe Mr. Katungu allow those who want to mute, so that maybe someone wants to respond. So the remaining part, there are 10 questions, so we'll see how we can be a bit fast. So I want to make it more interactive. So in case you want to respond, I may not see your hand. Maybe Mr. Katungu, are we able to allow the student to unmute now?
Yes, students should be able to unmute. Mr. Grafton Stongwa, are you able to try to unmute yourself? We confirm? Okay.
I've done so.
Okay,
Okay,
thank you.
thank you so much. So,
Yeah.
when you are not the one on the floor, as our parliamentarians would say, please ensure that you are muted. When you have a question, unmute yourself and speak. Thank you.
Thank you very much.
Sure.
Mr. Katungu was really guided. We want to make it more interactive. When you be answering, then I will tell you the mistakes. Because all these questions I've picked about 10, I want you to respond to make it more interactive. So if you are given a chance, if someone is contributing, then all of you have to be on the mute. So take note, because otherwise we're going to be having echoes or that. So I'll be very happy if it can be more interactive. So this question I picked in September, which they wrote for CA2.1. It was question 1B. Farmer's Nest is in the process of accounting for the acquisition of another subsidiary. So they had already acquired a subsidiary, but they wanted to acquire another subsidiary, which was Hope. Okay, so for that, okay, which was Hope. Then, and as identify a number of issues, so there were some issues when reviewing the fair value of Hope's net asset. One of the issue relates to the legal suit by one of the Hope's customer for allegedly supplying a fault goods, and the customer is claiming damages amounting to 8 million. Hope legal team has advised that based on the precedency, it is very unlikely that a court will award damages to the customer. The fair value of contingent liability of the claim was 2.2. Based on the very low probability that the customer succeed, then Hope has correctly applied IAS 37, which is provision contingent liability, when they were preparing it separately. Remember when I say separately, the parent will prepare its own financial statement, subsidiary will prepare its own financial statement, then will prepare consolidated. So when Hope prepared its own financial statement, they had accounted for this contingent liability using IAS 37, and it was correctly accounted for as a contingent liability. Now the requirement. So this is what came in the exam. Discuss how the above transaction should be treated in the consolidated financial position of Nest. It was 6 marks. It was just copy and paste. So as I've indicated, maybe in case you raise up the hand, in case you haven't been called, you can simply unmute. If someone is contributing, then you have to be quiet. So I want us to make it more interactive. Then I'll guide you how you lose marks. Anyone who can come through? Who can attempt this one?
Okay.
We are discussing.
I'm here.
If it's possible, you can introduce yourself that we know you.
Okay, my name is Vincent.
Okay, yes, Honorable Vincent, can you attempt?
So just to attempt this question, maybe I would start by stating that according to IS 37, in the separate financial statement, since it is not probable that the company will be required to award damages, so it will just be disclosed. But when we come to the consolidated statement, since the directors have actually they have assessed it and then they've priced it at 2.2 million. So when we go there, it will be recognized as a contingent liability.
Okay, thank you very much for the contribution. Before I can come through, do we have someone who wants to add on what has contributed by Honorable Vincent? Okay, thank you very much for the powerful contribution. That's the answer. So what was tested in this question? Remember, there is a subsidiary, there will be a parent here, there will be a subsidiary, there will be an associate, then there will be what we call consolidated or group. So like in this question, so Hope, they prepared their own financial statement, which we call separately. So in their books, like Hope, then they used IS 37. And when you go to IS 37, if you have got contingent liability, we simply disclose it in the notes. So them, they simply disclosed it. So it was not shown, they did not show 8 million as a liability. That's in the separate, so which was correct. Now, when you come to the group here, when you are consolidating, instead of using IS 37, you're supposed to use IFRS 3, which is a business combination. And when you go to business combination, forget about probable. The key thing, as long as the fair value can be determined, like in this case, they were able to determine what was the fair value, 2.2. So what was the message here? There was a contingent liability which was not recognized in the books of a subsidiary, but which we need now to recognize because in the group, we're not using IS 37, we are using IFRS 3. So you can see at the moment, there's a difference between IS 37 and 3. So that's what was tested. You can see the honorable here, what he answered. Business combination requires that all liability, provided the fair value can be determined, you recognize, which is different from IS 37. Okay, I think we can see there. These are the answers. We'll share these slides, even on the website, Zika has already posted. Another interesting question is this one. This one came again in September 2.1. It was question 2B. Now take note, I haven't picked the entire trial balance. I've only picked the key areas, which of course there was revenue, which was in profit or loss. There was opening inventory. There were administration, distribution, those you know. So I've only picked the key areas, fundamental areas. So I've just said an extract. So it means I've picked all the entry. All of you know the first one is debit, credit. So in the trial balance, there was a deferred tax of 5,000 on the credit side. Then the company paid interim dividend of 1.2. It was on a debit. Then there was 12% redeemable preference shares, which was on credit. Then there was income tax of 6.2. Then there was other dividend of 5.2. Then there was additional information. So this was one of the note. They are saying the directors have estimated that 5.95 would be paid as tax on the current year's taxable profit. The balance on current tax account, so when say balance, they're referring to which one is the balance? They're referring to this one, C2, that's referring to here. In the trial balance, represent under or over. So here they haven't told you, is it under or over? Of under or over for 2023. We are in 2024. Then they're telling this was under or over for previous. Then L, estimate the net taxable temporal difference as at, watch out, is it as at or for the year ended of 15? The company is liable for the tax at a rate of 30%, required, prepared. So in this question, A, we are preparing statement of profit or loss and other comprehensive income, where we only take income and expenses. Then B, we are preparing statement of changes in equity, wanted to know how much the movement and decrease. Then C, we are preparing financial position. Now, before we go to taxation, I want someone who can comment. Where were we supposed to take 1, 2, interim dividends paid? Where were we supposed to present 10,000 as the redeemable preference shares and ordinary dividends before you can go to taxation? And I've told you the crew for every entry, even if you want balance, please don't go there on 80th to go and balancing. I've given you a crew. Go and aim for entries because for every entry is half mark. So before taxation, I want someone who can guide us in terms where we are going to take 1, 2, where we are going to take 10,000 and 3, 5, 5, 2. Any volunteer? Let's make it more interactive.
Honorable.
Yes, if
Honorable.
possible. Yes, Honorable. Okay, Chimfwembe. Okay, yes, can go ahead.
Yes. Let me try on the interim preference dividends paid of 1, 2. I believe these dividends were paid on the 12% redeemable preference shares. And as guided, the redeemable preference shares in the statement of financial position, they are presented under liabilities because these will be bought back, so they'll be treated as a liability in the statement of financial position. Therefore, even the dividends paid on the preference shares must be recognized in the statement of profit or loss as an expense. For now, I
What
end
about
there.
you? Can you give an attempt to ordinary dividends? Can you an attempt? The way you have propounded, I'm sure I can attempt also ordinary dividends.
Okay. Ordinary dividends. For ordinary dividends, we take them to, since this is a distribution of profits. This is not an expense. This is supposed to be taken to retained earnings or statement of changes in equity.
Thank you very much. I'm very happy. These are the accountants Zika are looking for. When they are propounding, they understand. That's the answer. How has he known? He has gone through IS 32. IS 32 requires that redeemable. It's a liability. You have got an obligation. So this 10, once you take 10 under non-current liability, half mark, not balancing. Once you understand, when you pay dividend to liability, take to profit or loss, another 1 mark, so far 1 mark, then dividend is not an expense, an appropriation you take to retained earning. So far, I have given him 1.5 mark. So he's just waiting for the 8.5. That's powerful presentation. Now we go to taxation, IS 12. Those who are doing financial reporting, whether you like it or not, if published will come, you meet vis-a-vis on Monday. So for now, we focus on taxation. Remember, this trial balance is at 31st December 2024. So if you check there, they have told us deferred tax as at 31st December, it was 5,000 on credit side. We know all of us, this is a debit, this is a credit. Then apart from that, in profit or in trial balance, there is income tax of 6.2. And they are telling us this 6.2 is under or over provision for last year. Then in the notes, they estimated 5.95. Then also they gave us a what? They estimated a what? They estimated a taxable temporal difference of how much? 15. And they gave us 30%. So I want any volunteer who can tell us which taxation will go to profit or loss, which one will go to financial position. Any volunteer, if possible, introduce yourself. Let's make it more interactive so that you give your have confidence. I want after this presentation, say, let Zika bring, we'll meet vis-a-vis. Anyone who can attempt? Highest 12? Sharing is caring. So if it will come in the exam, the same question we fail to answer, anyone can attempt? Honorable Grace, can you attempt?
Good afternoon.
Afternoon, Honorable Grace.
Okay, thank you. Let me just attempt on this one. So since they haven't told us whether the one that's in the trial balance, whether it's an under or over. So the guide is that if the one in the TB, it's on the debit side, meaning it's an under for provision. Then if it's on the credit side, meaning it's an over provision. So from the current year's estimation, which is the directors, they've estimated 5.95. Yes, so from that estimation, we can deduct the over provision from the prior. Then also they've gone ahead stating that there is a net taxable temporary difference on its net asset as at 3rd December 2024, which is equal to 15 million. So in this case, they want us to compute deferred tax, and deferred tax is normally charged on the temporary difference. So the temporary difference they've given us is 15 million. So we are going to charge 30% on the 15 million temporary difference.
Okay, then we get 4.5. So what happened when we compute 4.5, Honorable Grace? Where are we going to take 4.5? Is it the one we are taking to profit or loss, or we are taking to financial position? And is it under asset or liability? Those who are answering well,
No,
Mr.
since
Katungu is taking note of. Mr. Katungu is taking note of. When you go through Ed office, just ask for a pen, he'll give you.
they've clearly stated that it's a net taxable temporary difference, meaning it will give rise to a liability. So we'll take it under liability in the statement of financial position, not income tax. Oh, not the statement of profit or loss. It will go under liabilities in the statement of financial position.
So how can you relate 4.5 and the one which is in trial balance here? They have given 5,000. How can you relate this 4.5 and 5,000? Honorable Grace?
So, okay, so from the prior, we have 5,000. And for this year, the estimation is 4,500. So we are supposed to adjust since there is a decrease in deferred tax of 500.
So when you adjust it to go as a what in profit or loss, are we going to take it? Are we going to increase the expense or reduce the tax expense? When a bit has reduced, are we taking it as income or expense? Honorable Grace?
The liability has reduced, so it will be a gain on our end, so it will go as an income.
Okay. I'm sure next time when you be at the head office, go and see Mr. Katungu there. He should give you a pen at least. But go and introduce him, Honorable Grace. Thank you very much. I'm very happy the way the Honorable has propounded. So the way it will come, they will give you the estimate at the year end. So the estimate was 595. We estimated at the end. So what will happen, 595 will be taken as an expense in profit or loss, half mark, then you take same figure as a current liability. Then you adjust for under or over, like what Honorable said. Supposed to multiply by 30%, you have got 4.5. So this 4.5 now is at the year end. So it was supposed to be shown as a closing balance. Then the movement is what will go as reduction. So the example, this what Honorable Chimfwembe indicated, this was supposed to be shown as an expense in profit or loss. Then this is a computation for taxation. Then in financial position, it will be 4.5. How we are supposed to compute a tax? You pick the estimate for the year. Then you subtract 6.2 because it was the over provision. So next time, if it be on debit under, you add. Then there was a decrease. So this was a tax credit or income. That's what they wanted there. So this is a good question. Please go through this after this presentation. For now, we are simply highlighting. Hope someone has been helped or delivered from the spirit of zeros. We go to 2.1 September. This was question 3A. Briefly outline the classification of financial asset for measurement purposes in accordance with IFRS 9. It was 6 months. Who can come through? Those who are participating, Mr. Katungu is taking note of you. You'll be surprised when you visit the AD office. We need to be a bit fast. We need to manage time. Who can comment on this one? Any volunteer?
Honorable,
Yes, Honorable
Honorable,
Chimfembe? Yes, Honorable Chimfembe?
can try. Financial assets in accordance with IFRS 9 financial instruments can be classified in 3 ways. One, they can be measured or classified at amortization cost. They can also be classified or measured at fair value through OCI, other comprehensive income. Then they can also be classified as fair value through profit or loss.
Okay. Thank you very much for that. Do we have anyone who can add on what Honorable Chimfembe shared with us? This is okay. Yes, someone to add. Yes, Honorable
Just to add on what, yes, just to add on what the Honorable has shared, what will guide you on how to classify the asset, like how you are going to measure it, it's dependent on the business model and also on the contractual cash flows. So in a case where the asset is held to collect, so in that case, we can use the amortized cost. And when you're using this measurement, normally the transaction costs we capitalize. So to the fair value, we add the transaction costs. Then if it's held to collect or to sell, then we can use the fair value through other comprehensive income. And also when we are using this measurement, transaction costs, we also capitalize, so meaning we add to our fair value. Then other financial assets which are not classified in these two that I've given above, those ones we use their fair value through profit or loss. And when you're using this one, normally the transaction costs are expensed in profit or loss. Then for all these, the dividend income is always recognized in profit and loss. Then if it's if you are measuring a financial liability, normally I'm just thinking of amortized costs. So for financial liability, so most financial liabilities we measure at amortized. First, initial measurement, it's fair value, then you less in transaction cost, then subsequently you can use amortized cost. I submit. Thank you.
Thank you very much. What you have propounded, that's very, very powerful. According to IFRS 9, a financial asset can be a debt. When you say debt, you have got a contractual right to receive, like you have got a receivable or from point of view as a bank. So for a debt, there are 3. You can use amortized cost. When can you use amortized cost? If the business model, there's only having that one, is for what? For holding, and there are also contractual cash flow. Then transaction cost, we capitalize. That was tested last exam. Then fair value through OCI, if the business model is for both holding and selling, it means we are going to hold it for some time and sell. Their transaction costs also we capitalize. Then if it fails one, or if you want to avoid accounting mismatch, you can use at fair value through profit or loss. But when it's a fair value profit or loss, transaction costs are expensed. But if it's equity, financial asset is equity, like you buy shares, There are only two. There is no amortized cost. Why there is no amortized cost? Because there is no contractual cash flow. So there we use fair value through profit or loss. In that case, we use a fair value through profit or loss. Unless if the shares are for investment, then you can make irrevocable or permanent decision to measure at fair value through OCI. Now, whatever dividend received, you show it as the income. So thank you very much. She has propounded. These are the answers you can see. Maybe they have got a leakage there. Thank you very much. We'll try to see how we can manage time. CA2.1, it came as question 5B. It was a good question. And this is very practical. So the directors were in the books of H. Now let's just go through. They are telling us, we'll just start to be a bit fast. On 1st January 2023, they delivered equipment to a customer. The invoice amount was 2.5, which was immediately settled. So immediately the customer paid. And they agreed to be servicing the equipment for how much? For how many years? For 3 years, starting on January 2023. That's what they had agreed. Then they're telling us for servicing, they charge 0.6 million. Ignore discounting. Remember where the time value is the material with discounts. For now, ignore discounting. Then when they prepared financial statement for December 2023, they reported the entire amount 2.5. So in short, they recognized the entire 2.5. So they debited cash at bank and they credited the revenue. Then subsequently, after the financial year end, December, we are published. So we came across something. We realized that the transaction was not properly accounted for in accordance with IFRS 9. Before you can finalize, I think we did not account for properly. We did not follow IFRS 15. Then they have identified that IS 8 also must apply in terms of correcting the errors when they are preparing in 2024. Now, they have asked for your advice. Why? Because you are the expert in terms of the requirement of ISC 8 in collecting this prior period error. You must also show the entry required to collect the error on 1st January 2024 in the financial statement for December. So in simple terms, the company sold the equipment for 2.5. Then they agreed that they'll be servicing for 3 years and the servicing 0.6. So when did they sell? On January 2023. And they're telling us the entire amount was shown as a revenue in 2023. So they created revenue and they debited the cash at bank. Then in 2024, when you're in 2024, then I said, no, I think we made an error in 2023. So we're saying now, how should we go about correcting this? And if they will be correcting, how should we address it? This is a practical question. Who can attempt? Who can attempt? We have got a number of questions. Want to conclude? We have got 6 more. Anyone to attempt? We may not see that your hand is up. You can unmute, then you contribute. Honorable members, we have failed to answer this one. IFRS 15 and IS 8. Okay, for the sake of time. Yes, Honorable Chimfwembe, Mr. Katumbi is taking note their names. When you'll be surprised when you go to Zik.
I
Can go ahead.
think here, yes, I think here there is need of splitting the invoice amount between the cost of the equipment and the service part. We need to split the two components because these two components have got let me say these are separate performance obligations, I would say. And we need to allocate the transaction price to the two components respectively. So there will be need of splitting so that the cost of the item may stand on its own, and then servicing the servicing component can also stand on its own and be treated accordingly. And that, I think that is going to be treated as must be treated as an expense in the statement of profit or loss.
Okay, thank you. So which standard have we used here, Honorable Chimfwembe?
It's IFRS 15, revenue from contracts with customers.
Okay, thank Thank you very much. And I like the way he has answered. Those are some of the mistakes. You just say IFRS 15. It's like I say any participant here. But when I say participant honorable Chimfwembe, then you know whom we are referring to. So these are mistaking the exam, just say IFRS 15. They say, the marker will know. Who pretend? The marker will pretend is not aware. So thank you very much. So when you quote IFRS 15, tell us 11 from contact with customer. Thanks. So like what has indicated here, there are two things. Performance obligation is a promise. So the company promised the customer they're going to give them equipment, then they'll be servicing for 3 years. Now take note, recognize revenue, account for income when you have certified the performance obligation. So for the equipment, yes, for the revenue for equipment, it was supposed to be recognized on 1st January 2023 because they certified the performance obligation. But 0.6 was supposed to be certified over 3 years. So in this case, it was wrong to account for 0.6 as revenue the entire in 2023. This one was supposed to be recognized over 3 years. Now, when have we realized? We have realized in 2024. So in this case, the error which was there is to account for revenue for year 2 and year 3 in year 1. So when you divide 0.6 divided by 3, each year the revenue is 0.2. So in 2023, we are only supposed to recognize 0.2. 0.4 was not supposed to be recognized. It was supposed to be deferred to be recognized in the future. So 0.4, since was recognized, but it was not supposed to be recognized. So are we going to reverse here? This 0.4, we are supposed to credit deferred income. We show it as a liability. Then we debit the retained earning, the opening retained earning, so that we adjust it. Then apart from that, because we are going to see in practice a requirement, when you prepare income statement for this year, 2025, you must also show comparative for last year. So for the revenue figure for last year, we need to go and adjust by 0.4. So to summarize, in 2023, we are supposed to show 0.4 as a liability. So we are supposed to adjust now the retained earning for the current year, because that's when it was what? It was discovered in 2024. So this one we are applying also IS8. Why? An error is failure to apply the standard, not to apply the standard correctly. And when we are collecting the prior period, we apply retrospectively. That's why they say some students were showing us prospectively. So we need to collect, because according to IFRS 15, only recognize when you have certified the performance obligation. That's why they have come with 0.4 by debiting retained earning, because 11 at the end affected retained earning and show it as a deferred income. Then the revenue for 2023, we're supposed to adjust also by 0.4. Then in current year in 2024 now, we are going to recognize 0.2 as income. So the remaining that deferred was 2. This is a good question. After this lecture, or go through this presentation or assignment. Okay. Number 5, it was September 2024, not the current year, question 3. They are saying, briefly explain the requirement for the LSA according to IFRS 3. So what I indicated, this is IFRS 16. As a LSA, when you are answering, the accounting treatment will depend whether is it a finance lease or operating lease. Finance lease is where substantial risk and words have been transferred. So if it's an operating lease, the LSA is the legal owner who continue showing the asset if it's an operating lease, we'll continue showing the asset, then the rental income will be recognized on a straight line basis. But if it's a finance lease where substantial risk and words have been transferred, then in that case, the asset is derecognized, then you account for this receivable. That's what was tested here. It was theory. Now, what I will test here. So have you seen this was a marking key? I'm just a draft, suggested or sample. I've said a sample, not real. I just based from the past experience. So the meaning here, explanation, just went by answering, accounting treatment will depend on the nature of a lease. Immediately, you are blessed by how many marks? Half mark. Then by telling us about the types of lease, operating lease and finance lease, 1 mark. By defining what's a finance lease, substantial risk and what have been transferred to operating lease, 1 mark. Accounting now, how we account for this, 2 marks. Then operating this 1.5 marks. So if you check here, that's our 6 marks. So if you just go to accounting without explanation, then you lose out the marks. So I'm sure I wanted just to give you a clue. Question 6, it came for D8 last sitting. It was for question 4, number 1. Explain the relative advantage of accruals accounting as compared to cash basis. It was 4 marks. Then it was the same question, number 6. As part of reorganization, the company was doing a reorganization of an operation. They would pay redundance of 80. When you say redundance, they would declare redundant. They will pay them 80,000. Then the remaining employees, those who remain, they have to be retrained and they will pay 25. So in short, we want to see who can just give us one advantage of accruals compared to cash basis. Then how should we account for VC 80,000, which is for redundance, and 20 when you apply IAS 37, 2 marks. Anyone who can comment? We're running out of time. Any volunteer? Mr. Gatungu is taking note of those who are presenting. You'll be surprised. Team members who can attempt? Okay, for the sake of time, accruals accounting, as I'd indicated, is where you recognize income when you have earned, not only when you have received, expense when you have incurred. So it gives us more information, and there will be proper matching of income and expense in the period in which it relates. That's why remember the prepayment and accruals, that's one advantage. So it gives us more information, and there will be proper matching of income and expense which it relates. When you go to this one, what was tested is provision. Where are we supposed to provide? So what we are supposed to do is to define a provision. Provision is a liability of uncertain timing or amount, not and. Then when do we recognize a provision? When it's probable, there will be outflow of economic benefit, the amount can be measured reliably, and there's a present obligation. Now, when you go to restructuring or reorganization, this one, if you check even CA3.1, it came under consolidation, where they brought about redundancy. So take note, this, if you check CA3.1, it was there in the exam. So the issue, are we allowed to provide for restructuring? The guidance of IAS 37.1, they must be a present obligation, where the company has come up with a detailed plan and the plan has been communicated, and only provide for directly attributable cost. Any cost relating to the remaining business should not be provided. So in this case, redundancy, you have got an obligation to pay. So we are supposed to provide for 80,000 by expensing and showing it as a liability. Retraining, any cost relating to the remaining business should not be provided. So this one was not supposed to be provided. We are supposed to expense at a time when we incurred. That's what was tested there. Accruals, it gives more information. Then there's a proper matching. Then when you use IAS 37, we are supposed to provide for 80, then 25 we are not supposed to be provided for. That's what was tested there. D8, question 5A, state 3 purpose. Remember the comments from conceptual framework? So they wanted 3 purpose for conceptual framework, and marks were there, 3. Then also they tested IS1 to explain the difference between monetary item and non-monetary item. So the clue here for one purpose is 1 mark. Then when you define monetary and you give an example. Team, who can help us to this one? Mr. Gatungu is taking note those who are participating. Who can attempt?
I think on the purpose, on the first one, you explained them when we started, when we were introducing at the beginning. So I said, but I'm remembering just 2. So it helps the accountant as they are preparing financial statements. Then it also helps auditors when they are auditing so as to express their opinion, whether the financial statements give a true and fair view.
Then is it possible you can attempt what is monetary item and non-monetary item, and you give one example of each?
Let me come through on that one.
Okay.
The gentleman, Honorable Chimfembe, I'm sure Mr. Gatungu is taking note. The participants so far, Honorable Chimfembe and Honorable Grace, they are leading there. Yes.
Okay, IAS 21, this is these are exchange differences. When we talk about monetary items, these are assets that have got how can I put it? Monetary items, these are assets such as cash and receivables, whose value has got a determinable. Let me say which have got a determinable value, as in terms of the amount. Then the non-monetary such as the inventory, which have not yet been which do not have a determinable value until such a time when they are disposed of. Like I've given an example of inventory. You only be able to realize or to know how much you are going to realize from the sale of inventory when the sale actually takes place, and that with that, it means you may sell the inventory at a lesser amount or at a higher amount. So the amount that could be indicated in your statements may not be the actual value which is going to be realized when the sale takes place. So the value on those non-monetary items is not determinable because of what I've explained. But in terms of monetary items, it has a determinable value because it is something that has been in terms of cash, it is already there. Then in terms of receivables, you have already agreed with the customers to say you're going to pay so much for these goods or for these services. So those are that is my submission for now.
Okay. Thank you very much. Thank you very much.
Honorable.
Yes, Honorable Mtinta.
Yes, just to add on what Honorable Chifembe explained. So in reference to IAS 21, which is the effects to changes of foreign currency, in addition to what monetary and non-monetary items are, monetary items, they are measured at cost. The initial measurement is at cost, and the spot exchange rate is the one which is used. And then for that is for both, for monetary and non-monetary. And then for subsequent measurement, the monetary items, we use the closing rate at the reporting date. That's how we translate them, using the closing rate. And then for non-monetary items, these we use the historical cost. We don't translate them. And then on subsequent, where the fair value is used, there I'm stuck, Honorable. But yeah, I just thought maybe the translation aspect should come in because they are referring it to IAS 21. I submit, Honorable.
Thank you, Honorable Mtinta. Much appreciated. Yes, like you can see the purpose, like what Honorable propounded, to help ISB as they are setting, to help accountant, auditors. Then as I've indicated, monetary item, the amount is fixed or can be determined. Then translation, like what Honorable Mtinta propounded, is when you are restating from one currency to another currency. Then now we translate. Okay, we are trying to monitor the time. I'm almost there. So they say on 1st April 2020, M acquired 80%. So they had acquired 80% and the share capital of the parent was 300. Then for subsidiary was 270. So in the books of the parent, this came in DA8 March 2024. In the books of the parent, the share capital was 300, subsidiary was 270, then acquired 80%. Then they paid how much? The cash consideration was 144. So 144 is what they paid to acquire shares. Apart from acquiring shares, there was also share exchange. So when say share exchange, they will buy shares, then they'll give out shares. What was the ratio? They are going to issue 1 shares if they acquired how many shares? If they had acquired 2 shares. So issue 1 if you acquired 2. Apart from that, they have been told that the retained earning was 110. So 110 was a pre. Then the market price of the parent was 2 kwacha. So what they wanted here is to know how many shares will be issued. So the meaning here, they are going to give out 1 if they acquired 2. But did they only acquire 2 shares? No, they acquired 80% of 270. So what's 80% of 270 shares? What are we getting? 80% of 270?
216.
216. So 216 are the shares which they acquired. Now, when you are computing cost of investment, not about the shares acquired, but what you are going to issue. So here we put X here. So in this case, we say 216 times 1 divided by 2. So how many shares were issued? 216 divided by 2? How much are you getting? Accountancy.
108.
108.
Yeah, so 108 are the shares which they had issued. Now remember, in accounts, not about the shares, but the VAT. So what were we supposed to do? We are supposed to multiply now 108 times 2. So that will be the cost of investment, which was supposed to debit cost of investment. Then since this was not recorded, you multiply number of shares times nominal value 1 kwacha, you increase the share capital, then the balance will increase the share premium. That's what was tested there. Then the key thing, they are using fair value instead of proportionate. So it means the good which they computed will be for the parent and non-controlling interest. Then what was tested here, the carrying amount was 150, but the fair value was 155. So you are supposed to get the difference, which is 5 as a fair value gain. Then also for land, the carrying amount was 250, then the fair value was 260. So there was a gain of 10, which you have to come and use when you are computing goodwill. Then this one was also very important. You can go through. There was internal generated brand, which was not recognized, but the fair value was 20. So we are supposed now to recognize. So basically here, this was a cash, then this is a share exchange, then this is a NCI. So since we have used fair value, when you come on this is a share capital, retained, then fair value adjustment. So this was a positive goodwill. So this goodwill was impaired by 15. So you credit goodwill, then you share between the parent and the non-controlling interest. Then you increase the share capital and share premium. IS10 was events after reporting. So they wanted adjusting. Those which need to adjust, non-adjusting event, they are not supposed to be adjusted. Qualifying asset are those assets which would take substantial period of time. I'm trying to manage time. There. Then question 10, go through what was tested here. They gave us the profit or loss. Then peace, who is a parent, acquired 60%. Then of sadness. Normally even give a clue. P is a parent, the first one. S sadness is S a subsidiary. Then they also acquired 30% in an associate. So the key message here, we are preparing on 31st December. Then when did they acquire? On 1st April 2021. So what has been tested here is when you come to this result, this is for 12 months. But did we have it for 12 months? No. So it was from April to December. We had it for how many months? How many months? From April to December?
9 months.
9 months. So the issue, so the
Honorable, have we ended? We can't get you.
The presenter has been logged out. Maybe he's trying to log in.
I think network.
It's network.
Okay, you can hold on as I try to engage Mr. Msonda.
Was just a few minutes after I reconnect. All right. Hello, excuse me, Mr. Kachungu. Hello.
Hello, Poland.
I've just been in touch with him. He's trying to connect. He had been disconnected for some minutes.
Okay, all right.
All right, thanks.
Good afternoon. Good afternoon.
Afternoon, welcome back, Mr. Msonda.
Thank you. Sorry, I was logged out. Just a moment, we are almost concluding.
Good
Okay.
afternoon, Honorable.
Afternoon. I'm trying to share the screen now. Okay, thank you. I'm able to share. Just a moment. Okay. Just a moment. I'm trying to share. Okay, just a moment. Is it visible now? Hello, is it visible?
Yes, it is.
Okay, apology. Okay. I'm almost concluding. So I think before I was logged out, we were answering through question 10, which was the last part, and what was tested, I'm almost there. What was tested was the income statement. So I was asking how to consolidate. So for the parent, you get the entire 325. Then for the subsidiary, the common mistake is where you multiply by 60%. No, you get everything. Now, since it was for 9 months, only get 9/12. So the way if you come here, you get 325 half mark, then you say 9/12. So throughout, so if you check here, these are the respective workings. So what was tested here, for subsidiary, only get for 9 months, then no need of multiplying by 10%. Conclusion, normally for every correct entry is a half mark, and the comment is 1 mark. So ensure that you maximize in terms of entry. This is very, very important. As we are preparing for exam, ensure that you cover the entire syllabus. The institute is going to share the summarized examinable item. There's still time, 2 weeks you can manage to catch up. Then ensure that you know all the topics. Apart from that, know the examined area, i.e. the exam which went through. Then take note, there are no marks they will give you for balancing. They will give you entry for correct, they will give you marks for correct entry. Then avoid doing calculation on a calculator without showing. So always show the working. Then there's no negative marking. Even if you make a mistake, like you add an associate together, they won't penalize you. So that's why let's maximize in terms of entry. Then please make use of the chief examiner's comment. The one which I was going through, it's there on the website. Ensure to go through so that we can know the weaknesses which were made there. So take note of that. Then let's ensure that we maximize the time. So the message for us, let's ensure that we can do better. So this time, I know we have run out of time. Maybe we can respond to a few questions before we can end our lecture. So I hand over to Mr. Gatung so that maybe he can moderate in terms if we have got questions before we can end our presentation.
Thank you, Mr. Msonda, for that wonderful presentation. Ladies and gentlemen, do we have questions?
Yes, I want to ask.
Yes.
Proceed, McBean.
Yes, Honorable, do you have a video for summarize the standards, like a quick revision for standards, all the standards, which you can share?
Thank you very much. Yeah, as we are saying, the institute, of course, for you it's free. For me, they paid me for every voice there is invoice. Yes, I think I've got a summarized video which I can try to share later on. But for now, what I'm sharing is just this presentation will be shared plus the notes. But there are those in case they want the summarize the video which has covered all the standards. Yes, I do have.
Thank you so much.
Hope, Mr. Katungu, your people are not confused. They are too quiet, so I'm worried. Maybe we're overspeeding.
Okay, I can see there's one asking about the video. Yes, we are going to share the recording rather. We are going to share it together with a presentation by Mr. Msonda. Any question related to the subject? All right, with the silence, I'll take it that everyone is going out of it. Mr. Chisenga, Patrick, you can proceed.
I want to ask for more clarification over the answering of questions on the answer sheet. I add on the first presentation. The presenter said you can start with the easiest questions that you are comfortable with. And then in terms of answering on the answer sheet, I don't know if what I heard is what it is, where you can start with question 5 on the answer sheet, then the other, or you can just put them on in order so that you can just leave a space. If the one question 1, you leave space for question 1, you go to question 2, and then like that. I need more clarification on that. I submit.
Okay, thank you very much. Yes, there is misconception with students that when you open page 1 of the answer sheet, we must find the question 1. No. So when you open your answer sheet on page 1, what's important to write on top, you write question 5. So they know that the first question on question 1 is question 5. Then the other thing which maybe I didn't highlight, when they are marking for ZK exam, they use what call conveyor belt marking. So you find maybe marker 1 is only marking question 1 or 2 or 5. So to answer on page 1, you can start with question 5. If the next one, which would be simple, is question 2, again on page 2, indicate question 2. So no need of following the order. So that's very, very important. We always encourage, start with the question which you are confident, because it will be fast and it will give you confidence. So the message, what's important, write on top. On page 1, what I'm answering is question 5. Then they'll mark you accordingly. Hope I have clarified. So what's important is to number the answer you have presented.
Thank you.
Any other questions?
Sorry, sir. I was joining in and out because I'm at work, and then there were a lot of meetings coming in. I wanted just to get a clarity if this presentation is accessible through whether it was being recorded. Sorry.
Thank
Mr.
you. The
Katungu?
presentation is being recorded and it shall be shared with everyone that is writing financial reporting, be it in the diploma or the CA.
Thank you so much.
Mr. Katungu, over to you. It seems there are no further questions.
Thank you, Mr. Msonda. I take it we have exhausted our questions. So I wish to take this opportunity in closing to thank every one of you that has participated in this meeting. We might this time around go further and just check on how you perform during the December session. For those of you that will have challenges, we may send out some questionnaire or something just to get your views so that we know how we can best improve the ways in which we try to prepare you for the exams. Mr. Msonda did jokingly say, some of you are thinking we are failing you so that we raise enough money for our building. So one open secret is that the Institute thrives in seeing you graduate, because we want you to be our ambassadors, not in the classrooms, because we already have Mr. Msonda being our ambassador in the classroom. We want you in industry so that people know how credible our qualification is, how good people that are Zika qualified are. Okay? So it gives us pride. There have been times when I was working in the inspections, so visit mines, and you hear people express their gratitude at what kind of performance some of the colleagues that have gone before you are out there in industry. So the idea is that we want you to go out there, graduate, but graduate with knowledge. We don't want to make you pass just for the sake of it. We want you to pass by showing us that you know what you have learned, and you can only prove that by performing well in your exams. And so as part of that effort, we have such meetings. Like I mentioned during our opening, there are more meetings to come. If you are registered for more than one paper, please take time and listen in on the other presentations as well. This recording once more will be shared. In addition to it, there are several recordings that are on our website that you can make use of. Okay, you have the Q&As you can refer to. Mr. Msonda emphasized on the chief examiner reports. You can equally refer to that. Attempt as many questions as possible. As you practice, you are left with a little under 2 weeks before your exam. So use the remaining time very, very well. Otherwise, thank you. We end here.
Thank you very much. Wishing all the best.